Hello everybody and welcome back. In this video we will talk about MSCI. They just reported earnings, and in this long video, you will have all the information you need to know about MSCI's Q3 earnings report. I believe this video will be long because you will have a lot of information, and I believe this is the only video you need to watch if you want to make an informed decision about MSCI, whether you buy or whether you sell or you hold. This is the only video you will need, because in this video I want to show you the report, comment on it. I am a shareholder of MSCI. I know the company quite well, so I have a couple of comments on this one, so you will get a lot of information. Also, I want to show you some charts, some slides on Fiscal AI. We'll play around with some numbers. I will show you how the business is improving, and also together we will look at the slides of the company, what they have to say in more details, and we will also listen to the earnings call together. So I will just comment on the earnings call. I did not listen to the earnings call yet, and yeah, looking forward to it. Actually, as a shareholder, I want to know what the management is saying. So yeah, an action-packed video, pretty long. Take a cup of tea, take a cup of coffee. I just took coffee, life is good, and we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor, I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. I basically do GARP investing, so quality investing, growth at a reasonable valuation, and I've been doing 25% per year. And the goal with this YouTube channel is to help you become a better investor, so you can achieve 25% per year. Okay, so full disclosure, I own MSCI. I want to start this video saying this. The report was very good. The stock is up plus 8% today, and this is roughly 8% of my portfolio. So this will contribute a lot to my performance, and so far I should have a performance of 22% year to date, outperforming the S&P 500 so far. So I made a video a couple of days ago about what I was expecting for this earnings report. So here you have a couple of metrics that I wanted to monitor, and in this video today we will check if this is true or not, if these metrics are good or not. We said we want to check the subscription growth, the growth rate. We want to check the operating margins, and we want to check the new segments, how they are operating. I am following very deeply MSCI, and not a lot of people have talked about this on YouTube, but in the first part of 2025, as you can see here on Fiscal AI, you had a Barclays conference here, okay? You had a Bernstein conference here, a Barclays, another one, Barclays Americas conference. In these conferences, the management team is literally saying what they will do in the future. And in 2025, the management has shifted their strategy from growth to efficiency. And now the goal is to improve the margins now, to become more efficient. This is why I say I want to check the operating margins. Just in case you don't know MSCI, I don't know why you're watching this video. Maybe you want to do some due diligence before buying. MSCI is a very simple business model. 50% of the business, that's the index segment. So the MSCI World Index, the benchmark, okay, that's the crown jewel of the business. You have very, very high margins. That's 50% of the business, of the revenue. 25% of the revenue, that's analytics, okay? Analytics, lower margins, software companies to help fund managers, okay? And the remaining 25%, that's an ESG segment, so software, analytics, but specialized in ESG and sustainability, and private equity, let's call it this way, private firms. So not very important. What is really important is the index, analytics, and then the rest. So they said at the beginning of 2025 that they were not happy with their business operations, and they wanted to focus on their crown jewel. So index. If you look at the margins for the index segment, so the most important segment, we are north of what, 70%? Can you name 10 businesses with 70% operating margins? I don't think you can. It will be very difficult. So they have a jewel and they want to grow this this segment. And in the meantime, for the other segments, they just want to become more efficient. They don't care about growth. They want to improve the margins. So what I said in this preview video was, I'm expecting the index segment, the biggest segment, to grow. And maybe it will be a drag on margins because you are maybe paying for the growth, okay? But for the other segments, the climate, ESG, or the analytics, I want better margins. And in this video, we will check if the management has done what they said they would do, okay? I also want to read between these lines the management tone about client retentions and renewals, because in the last quarter, Q2, I made a video on this on my YouTube channel. They talked about a deceleration in the growth rate for the subscription rate of asset managers. It was only 6%. It was growing. You want to check if this is still growing or not. Same thing for the net new subscription run rate. Well, now I'm talking about technical stuff now. But we will see. We will see about all the subscription rates, if the growth is back or if the growth is decelerating. Also, we want to check the guidance for next year, obviously, and what they say. What they say, if they are talking about more Capex or more uncertainties about inflows of ETF, etc. If you can cross-read things, you had FactSet that recently reported earnings and the stock got demolished. You had FactSet, which is an analytics company. They disappointed investors, okay? The revenue was not growing that much. They said they were investing in AI, but because this is an analytics company, for sometimes you have to invest more cost. So the revenue was growing single digits, but the costs were growing much more. So it was a bad sign for FactSet. Margins went down because of heavy investments and the stock tanked. Now, for FactSet, which is a competitor to MSCI, the year-to-date performance is minus 40%. So now, entering the Q3 for MSCI, will the analytics segment perform well? Well, this is why you clicked on this video, okay? This was for my introduction. I think we can start talking about the report first, okay? Yes. Okay. So here is the report for the third quarter, 9-month 2025. How can I put it? In full screen? No, that's too big. I think you see good here, right? It's good, big enough. Okay, you had operating revenues up 9%. Organic operating revenues growth of 9%. Basically, a standard revenue growth rate for such a resilient business model. 9% is good. Recurring subscription revenue up 8%. Asset-based fee up 17%. You probably know how MSCI works. They are a benchmark to the world, to fund managers. So if you have more inflows of money to ETFs, MSCI gets a royalty. So now, as stock markets are at all-time highs, MSCI makes more money. MSCI is a royalty company on the stock market overall. So if the stock market is going higher, yes, this asset-based fees will go up. Maybe I can show you something else. I can show you on the financials tab on Fiscal AI, this metric, segment and KPIs. I want to check the AUM on a quarterly basis. AUM, yeah, that can work. You have trillions of dollars linked to this one, but that can be fine. Okay, fair enough. In blue, this is the AUM in ETFs linked to MSCI equity indexes. Okay, more capital is linked to MSCI. And MSCI, the way it is working is you get a cut, a royalty out of how much AUM is linked to you. So if this line is going up as a royalty company, MSCI makes more money. This is why they say, when they say the AUM fees are up 17%, it's because markets are going higher and you have more inflows of money. And what about inflows? Here we go. In orange here, you see on a quarterly basis, since COVID, the inflows, the cash inflows when it comes to their ETFs. When markets went down in 2022, nobody wanted to inject more liquidity into the system, so it was flat. And then, since markets are rebounding, it is going high and higher and higher. And at the same time, it balloons the AUM linked to MSCI. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Okay, so yeah, makes sense to start the quarter with this. You have more assets linked to MSCI, so MSCI makes more money. Okay, it was only the second line. I don't know how long this video will be, but I'm sure you will get a lot of value. Operating margins of 56%, adjusted EBITDA. We'll talk about the margins later. Also in this video, I have prepared a Google Sheet for you. So we'll play around with some numbers. Organic diluted EPS is up 19%, which is very good. Adjusted EPS up 16%. What is the adjustment for maybe acquisitions in the past? Not sure. Organic recurring subscription run rate growth of 7%, retention rate of 95%. In the third quarter, we did a massive buyback program and we paid a small dividend, and we just authorized a $3 billion buyback program. And if you are watching my channel, you will not be surprised to see this because I've made plenty of videos about this. I'm expecting MSCI to benefit from this new environment with lower interest rates because that's part of their philosophy. MSCI, for the past 10 years, they have taken more debt to do more buybacks. Every year, they're buying back their shares, and they do this with debt. Now, since the cost of debt went up in 2022, when interest rates went up, the debt was more expensive, so they stopped the buyback program, and they did not take more debt. And now, as interest rates are trending down, MSCI is taking more debt to do more buybacks. And I made a video about this a couple of weeks ago. They recently announced a new debt program to do more buybacks. Maybe that's here in the Barclays conference, September 2025. So between Q2 and Q3, you had this new announcement that the company increased the debt level by $1.25 billion. Let me spoil you the fun right now. They did, here we go. Now you can see. During this quarter, Q3, they did a buyback of $1.2 billion. So they very recently got more debt, and they used all this debt in less than 3 months to do buybacks. It shows a lot of confidence in the management team. They really think their stock is cheap right now, and they are walking the talk. Literally, during this call from Barclays, you have the CFO, Andy, that is talking about this new debt program, and he's literally saying publicly, we are doing buybacks with this new debt. We didn't know the exact number. Well, it seems like they used all this new debt, everything, to do massive buybacks during this quarter. It shows how cheap the stock is in the eyes of the management team. Okay, let me continue. So now that they are in this buyback field, they want to do more buybacks. They just recently announced a $3 billion buyback program. And what is the market cap of MSCI after today? 44? That's what, 7%? 44. 3 out of 44. That's 6.8. Yeah, 7% of the market cap will be repurchased. And I'm guessing they will be very aggressive in terms of timing. They want to do buybacks now. Okay, so now this was for the introduction of this document. If you look at the first numbers, you will see... Come on. Here we go. You will see that the revenues are up 9-10%. Operating income is up 11%. and the margins are trending up from 55% to 56%. So when you do some research on MSCI, and when I talk to you about the Barclays conferences at the beginning of 2025, and when you see management saying, we want to improve efficiency, yes, they are doing it. They are walking the talk. This is good. And this is something that not a lot of companies are doing, meaning when you have a problem, when a company has a problem about efficiency or not growing that much, you announce what you are going to do publicly. How long does it take for the company to pivot? How long does it take? You can take the example of Evolution AB. They've been saying something for 2 years and they are not executing fast enough. Well, for MSCI, it took 6 months, 2 quarters. It shows the flexibility and the quality of the management team. And don't worry, we'll talk about the numbers later. I will play around with some margins and add some comments here. So I just want to skip this part of this table because you will understand better. But the earnings per share are growing by 19% per year. This is very good and very bullish. Okay, what is the CEO telling us? In the third quarter, MSCI delivered strong financial and sales performance, including record Q3 recurring sales in our 2 largest product lines, Index and Analytics. In Q2, these 2 segments were the worries of analysts from Wall Street. So right away, the CEO is addressing the problem. Right away, first line, okay? And also with hedge funds and banks. First line, first sentence, because I've seen nobody on YouTube talking about this. This is great. I'm very excited to do this video, by the way. In Q2, last quarter, the stock dropped 8% in the day of the earnings, during the day of the earnings. And they were not happy with their performance. And they said, the subscription run rate is 6% for asset managers. And analysts, during the earnings call of Q2, asked questions. Why are you not growing so much for asset managers? This is the client. These are your clients with the best margins. This is the most profitable segment you can have, and you are only growing 6%. So is this bad? Why are you only growing 6%? Well, right away, the CEO, Henry Fernandez, is talking about index analytics, first sentence, and with hedge funds and banks performance. You want to talk about hedge funds first, asset managers, okay? He understands how markets work. I mean, this is a company that is operating in the stock market industry, so obviously they know how to please investors. This is also why I am invested in MSCI. They know exactly what to do to make shareholders happy. In addition, we achieved a record asset-based fee run rate driven by 17% growth, which reflected record AUM levels. I showed you the blue lines before. About $6 trillion combined with ETF and non-ETF products linked to our indexes. Okay, our Q3 results affirm that MSCI's indexes, analytics, and data are foundational to investment portfolios around the world, demonstrating our role as a global standard setter. Meanwhile, our expansion with new client segments highlights the benefits of our relentless innovation. By enhancing our focus on individual segments, we will further accelerate innovation across product lines and asset classes. Okay, fair enough. If you don't know, the index segment is the most important one, and they just recently hired a lady that is a superstar, specifically in this index segment. If you talk about the AGM, by the way, I will navigate on Fiscal AI. You can do the same. If you want to use Fiscal AI, you have a discount, an affiliate link in my description to get it 15% cheaper for you. Literally try it out for 2 weeks. It's completely free for the first 2 weeks, and then you can see if this is a good fit for you. Please use Fiscal AI. I'm using this on a daily basis. Okay, so you have Jaina Haynes here that was recently hired for MSCI to supercharge the results in the index segment. so the most profitable segment. Who is Jaina? Well, you had this AGM conference in September, and she spent 35 years in the industry, 16 years with MSCI, and for 2 or 3 years she went to work with Cathy Wood at ARK Fund, ARK Innovation, and now she's back. So this is it. Okay, so she was the boss of the index segment. She has been working, she has worked 16 years with MSCI, and prior to returning to MSCI almost 2 years ago, she was the chief strategy officer at ARK Investment Management, and today she comes back. Well, I don't know what it tells you about the culture of ARK. I don't know what it tells you about the culture of MSCI. Well, she had a good internship for 2 years and now she's back. Okay, fair enough. And yeah, during this conference, she explains what she will do in this index segment to have custom indexes, better margins, better growth, blah, blah, blah. They want to be more aggressive to get more clients. But this is not the goal of this video. The goal of this video is to talk about the Q3. Okay, but I wanted to talk about this one because this is also a reason why the index segment is growing. Just because of Jaina. Just here, she's doing everything. She's the boss here. Okay, let me continue. If you look at specific lines, specific items, you have a revenue growth rate of 9.5%. You have a run rate and retention rate that are up 10%. And the organic subscription run rate was 7%. The retention rate was almost 95%. This is something that is really important. Just this line, the retention run rate. Here we go. Here. This is very important. And over the past few quarters, if you disappoint here, if the retention rate is bad, the stock drops almost automatically. In Q2 2025, this is what happened. This is the reason why the stock dropped, because the retention rate was bad. And you had bears, people that are bearish on the company, that highlighted this, saying, look at this, MSCI is not a high quality compounder because the retention rate is trending down. As you will see later, the retention rate, the churn rate is seasonal. So it goes up and down, up and down, up and down. And yeah, people are worried about this a little bit too much, in my opinion. Well, luckily for us investors, this retention rate is up 94.7% compared to 94.2% last year. So an improvement. So bears have nothing to say now. Okay. Expenses. Total operating expenses are up 7%. Can you spot what is happening right now? The revenue is up 10%. The expenses are up 7%. You have a gap of 3%. Operating income is up 11%. This is the reason, okay? Headcount, very important line, is up 2%. So they hired 2.2% more people. As I want to say so many things in this video because I want you to know everything what is happening. Let me spoil you the fun a little bit with the Google Sheet. So this is a Google Sheet I have worked on and I will show you later, but you will see that the SG&A expense for this company is flat on a year-on-year basis because they don't hire anymore. They are hiring 2.2% more employees. But without context, you don't know if this is good or not good. And I can tell you the context. Last quarter, so in Q2, they had 2.5% more employees. So they are reducing the increase, okay, in hiring. In Q1 2025, they hired 5% more employees, 5.6%. And then in Q4 2024, they hired 5.8% more employees. So over the past few quarters, the pace of hiring has decreased. They're hiring less and less people, and we knew it from the conferences in early 2025. This is why I started this video saying, yeah, can you check the Bernstein conferences? Pretty important. They give us a lot of data. Guys, please use Fiscal AI. I mean, you will get so much value if you just get access to these conferences. I don't know how you can access these conferences without Fiscally Eye. I'm monitoring everything in this single website. And we knew that they would not hire a lot of people anymore. They were talking about this in the past. In May 2025, in the AGM here, you had information. The management team clearly said, we will invest in AI to have better analytics tools. We will focus on AI in the future, but we also want to focus on efficiency first. And I made a video about this back in the days. You can check on my YouTube channel if you want. May, June, something like this. And they said we are cautious about our costs, but we want operational leverage. So the goal is not to hire as many people as possible, is to implement AI with as little cost as possible. So we will probably not hire so many people. And the management is walking the talk. Literally, textbook, they are doing what they said they would do, which is lovely to see. If you, I don't know how your portfolio is doing, but sometimes you have stocks, companies that you follow, and they are struggling to execute. Well, MSCI is not struggling at all to execute. They do exactly what they say they would do. Okay, so this was for this line, headcount. So far, I hope I'm giving you some value on this video. I've seen 0 videos like this on YouTube. But yeah, it's always important to cross-read what the management has said before and to see if they are operating. Cross-read the conferences, cross-read the last quarters, Q2, Q1, cross-read the commentary from the CEOs. And this is also why I'm really looking forward to hearing what the CEO is saying here during the earnings call. We'll talk about this in this video. In this video, you will have everything. Everything. The comments, the background, the global picture, the competitor analysis, the Google Sheet, the earnings call. You will have everything in one video. Okay, other expenses, we don't care about this. This is very minimal. Income tax, this will be pretty important. On a year-on-year basis, they pay less taxes. You see? Last year, they had a tax rate of 21%. Now 18%. So you are basically cheating, and we will talk about this later. So as a result, because you pay almost no tax here, fewer taxes, the net income is up 16%. And because you are doing buybacks, the earnings per share will be up by more than this. Okay, now, again, I'm coming back to the conferences because that's very important, extremely important. And nobody on YouTube is talking about this. The conferences here are maybe the most important part of 2025. And if you have not listened to them, you are missing out. They said in the conferences, let me repeat for the last time, because I mean, that's the third time now. We want the index segment to grow. And we want the other segments not to grow, but to be efficient. Let me show you the importance of this. Common size, index, analytics, sustainability, all other private assets. This is the 4 segments the company has. In purple, that's the index segment. And the lines, the percentages you see here are the importance of, in terms of revenue. Meaning now you see 56%. The index segment represents 56% of the revenue. The analytics segment represents 23% of the revenue, and it is trending down. The red line, that's the ESG segment, representing 11% of the revenues, and the private assets part, 9% of the revenues. Okay? Now, in 2021, 2022, the ESG segment was growing at 30, 40, 50% per year. It was really trendy at the time. And yeah, this is the reason why the ESG importance went from 5, 6% to 11%. And as you can see here, for the past few quarters, the ESG segment is not taking more importance. You have plateaued. I can show you this, it will be better for you. The sustainability part is plateauing for 2 years now, since September 2023. In terms of importance when it comes to the revenue, we are stuck at 11%. This is not growing, okay? And very recently, at the beginning of 2025, the management acknowledged this and says, yeah, maybe we will not focus on ESG. So first thing they said is, we want to change the name of this segment. we will no longer call it an ESG segment. We will call it a sustainability and climate segment because the ESG word has become political. Fair enough for them. Okay. Secondly, we will not invest that much in the ESG segment. Third, we will focus mostly on efficiency. So they are, again, walking the talk. You have another segment that is the private assets here. They are almost saying the same thing, a little bit less, but this segment is very low. That's 9% of the revenue, not a lot of margins here. You have the analytics and the index. Index is their crown jewel, more than half of the revenues. They want this to go up in the future. And you have the analytics segment. Analytics segment is trending down over time. They said they want to focus on efficiency and margins. Okay? Okay, so now you understand the business model, you understand the focus of the management team, you understand what they want the purple line to go up again, and they want the other segments, the three other segments, to not grow that much, but to be efficient, to squeeze the juice out of this lemon. You want to squeeze as much profits, you want to improve the margins as much as possible for the three laggards here, and the growth driver is only the purple line. Okay, so you want to check if this is true. Let me spoil you the fun. On a quarterly basis, you can see this. The purple line is going up, so it is working. The green line is going down, this is working. And the red line is going down, the yellow line is going down. This is working. The purple line is getting more importance. Okay, that's a little bit too advanced. I don't want to lose my audience here. Okay, so because we know what the focus of the management is right now, are they executing? So we can check. First, the index segment. The index segment, so the crown jewel, it is growing the revenue at 11% per year. Is this good or bad? Well, you can check. You can check. Let me remove this. Comment size, no. Let me put this toggle, change in index. Here we go. For the past few years, this has been the growth rate of the index segment. Since 2013, what has been the average and the median growth rate? Average 11% per year. So for the past 10 years, this segment has been growing 11% per year, and median 10. So 10, 11. Okay, so 10, 11 is basically average. What can you see here in 2021? Because markets were at all-time highs, with a lot of inflows and infinite money and quantitative easing, obviously, the index segment was growing 20% per year. And in 2022, only 4% per year because we entered a bear market. Now, about the quarterly figures, what can you see? You see that when markets go down, this goes down. Obviously, 25% of the revenue is linked to the stock market indices. So when markets go down, 25% of the revenue is linked to the market and it is trending down. And when markets are going up, this is going up. What you can see is an average performance. 11% growth rate. You are back to the same growth rate you had 1 year ago. Nothing really sexy, nothing really exemplary, but you are growing. In Q2, in June, people were not happy because the index segment was growing at 9%, as you can see here. So less than 10%. And I remember vividly people on Substacks, on Twitter, they said, MSCI is decelerating. What if you have a growth rate of less than 10%? It's 9, but it can be 8, 7, 6, 5. And I agree, that's a big worry. So they did great work analyzing this, highlighting this. But it seems like MSCI is fighting back and doing everything they can to be above this 10% threshold. Okay? Well, if they can sustain 11% per year, this is good. Now, as I told you before, they hired a new lady to focus on growth in the index segment, but maybe at the expense of costs. They will grow, but they will need to hire more people, give more incentives to salespeople. So maybe the margins will be impacted. Well, let's check. Over the past year, the adjusted EBITDA margins are flat. So you are continuing to grow 11% per year, and your margins are not touched. Congratulations. Very good. This is the best case scenario you can have. You have a reasonable growth and the margins are not trending down. Pretty good. On a nine months basis, margins are slightly trending down. So this is what I feared. So yes, I'm expecting lower margins in the future. For Q4, for example, I'm expecting lower margins for the index segment, but I'm expecting more growth. Okay. Index operating revenues were up 11%, asset-based fees are up 17%, and recurring subscriptions are up 8%. The growth in revenue attributed to asset-based fees were primarily driven by ETFs linked to MSCI equity indexes and non-ETF index funds, primarily due to an increase in average AUM. Yes, I mean, if you are a fund and stocks are going up, the AUM is going up. You don't need magical inflows of capital. You just need markets to go up. So because markets are going up and now at all-time highs, well, MSCI is enjoying more AUM, so more fees. Obviously, nothing really spectacular here. It's not because of execution, it's because of luck, because MSCI will benefit from higher stock prices. Partially offset by a decrease in average basis point fees. This is a yellow flag. This is the first yellow flag I'm talking about on this video. And I want to be too biased and too optimistic. I like this report, but you have a few yellow flags here. One of them is this one. Let me put this in red, not in green. Pink, fair enough. A decrease in average basis point fees, which means if you want to invest in the MSCI World Index, you can buy an index fund. It will be at minimal cost. The cost will be a few, like 0.5%, 0.05% minimal cost. As the world is getting more digital, you will have more competitors, and the percentage, the cost will shrink over time. So it's as if the take rate for MasterCard and Visa was trending down. Yes, you have more volume for Visa and for MasterCard, more transaction, more payments, but the take rate is trending down because you have competitors. You have PayPal, you have Wise, you have American Express, you have many other competitors that are entering this field. In this new world of online banking, Visa and MasterCard will be forced over the years to decline the take rate. PayPal is doing this, for example, and this is a drag on their performance. Well, for MSCI, it will be the same. The percentage of cost will need to decline in the future. By how much? I don't know. They don't talk about this. Maybe they will talk about this in the earnings call. So you grow your AUM. It's like Visa and MasterCard. I mean, that's a very good comparison. Visa and MasterCard are enjoying more transactions, more volumes, but the take rate is shrinking. I'm not sure about the take rate shrinking for MasterCard. I think it is actually flat or increasing. Such a quality business model. Okay, anyway, PayPal is a good example. PayPal has a take rate that is shrinking from 3% to 2%. Okay, let me continue. Index run rate is up 12%. The increase was comprised of more run rate, blah, 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 higher. This is not important. The increase in recurring subscription run rate was primarily driven by growth from market cap weighted and custom index products. This is the key, actually. The custom index products will be the next leg of innovation for MSCI, and they hired the new lady exactly for this. They want to capitalize on custom indexes, customized indexes. If you are a fund manager in Europe and you want to invest in quality companies, but you have some red areas, black boxes that you don't want to touch, like weapons, for example, the industry of defense, will you really compare yourself to the European index? Because in the European stock market, you have defense companies. So as a fund manager focused on quality without the defense companies, is it a good benchmark to look at the Euro stocks, for example, or the DAX or the CAC 40, etc.? I don't think so, because you don't compare apples to apples. So you want to call MSCI and say, okay, please MSCI, can you create a new benchmark for me, a custom index, European index, but without the defense companies? So I'm really comparing apples to apples here. And the MSCI say, yes, give me a couple of millions of dollars and I will do it for you. So this is it, your custom index products. I'm talking about one differentiation with the defense industry, but you can have multiple metrics at the same time operating. I don't want defense, I don't want tobacco, I don't want this, I want to increase the weighing in Japan, I don't want China. You can play around with as many metrics as you want, and MSCI will deliver. MSCI will create custom indexes for you, and you can cross-sell things across the MSCI ecosystem. By the way, MSCI in 2021 created MSCI One, which is a super app, super platform for the custom indexes, for the whole index segment, for the analytics segment, ESG. They want to get clients inside their ecosystem, and they want to cross-sell things. The analytics, the ESG, private assets, risk monitoring, index, custom index. So once you are inside this loop of MSCI, once you are a client, you stay inside this ecosystem. So having custom index products is a way to get more clients inside the ecosystem, and you will have more recurring revenues in the future. But it is not the topic of this video. It will be the topic of maybe in 2 years. Maybe a video in 2 years, because now it is just getting more traction. It is only the beginning. The increase reflected growth across all regions and organic recurring subscription run rate growth for index was 9%. Yeah, decent. Nothing exemplary, decent. Okay, so you are growing. Custom index products are working properly. More AUM and a decrease in basis point fees. This was for the index segment. So for all the Twitter accounts and all the Substacks that were crying because the growth was decelerating, well, the growth is still here and is still decent. Next segment is the analytics segment. And now you will see. The analytics segment, this is this one. For the past 10 years, the average growth rate of this segment was 5%, and the median was 5%. Okay, so not a lot of growth for this analytics segment. I don't like this segment at all. You have lower margins, and on a quarterly basis, look at this. The analytics segment was growth was 5%, and then in 2024 the growth rate was 11%, and then you are back to 5%. Well, what has been the growth rate of this analytics segment for Q3 2025? Let me scroll down. The growth rate was 5.7%. Yeah, that's updated. 5.68%. Nothing terrible, nothing extremely good. But remember what we said at the beginning of the video. The goal of this segment is not to grow very much. They are not investing a lot in this segment, but they want to improve margins. Did they deliver? Well, if you can look at the margins, growth of 6%, I would say, but the margins are going down. Another yellow flag, I would say not red flag. I mean, it's not dramatic, but it's bad. So a second point that is bad. I don't want this video to be how do you say it, to be too wonderful and too great about MSCI, too bullish, too optimistic. I also want to highlight the bad, because I want you to have the full big picture about this company. So a second point that is bad is the analytics segment was expected to be more efficient, because the management said this, and they are failing to do this. So for this segment, not executing. First, big bad thing. The margins went from 52% to 49%. So you lose 3 points of margins, which is quite bad. I remind you that the analytics part is 25% of the revenue. So this is a big segment. This is a big segment, and you lose 3 points of margins. This is bad. And over the past 9 months, the margins are not going anywhere. So yeah. For the index segment, on a year-over-year basis, no change in margins, but for the past 9 months, a change in margins. And for the analytics segment, that's reversed. On a year-on-year basis, margins are trending down, but for 9 months, it's okay. So maybe this quarter was particularly bad. What you want to check for the Q4 for MSCI is is this trending up? You want to check this. You absolutely want to check this. This is very important. Now, let me continue with another segment that is expected to be more efficient. As I told you at the beginning of 2025, they want the ESG segment to be more efficient. So this is this one. Or I have two paragraphs after this. Do they mention why the margins are going down? Analytics operating revenues are up 5%. Organic revenue is up 5%. Analytics run rate is up 7%. The increase was primarily driven by growth in both equity, blah, 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 blah. Nothing about the costs. I want to know what is happening with the cost. I hope the earnings call will give me more information. Let's move on with the third segment. So, let me scroll down. Analytics, sustainability and climate. Okay, look at this. This is funny, and this is why I do this job, because I'm having a lot of fun. In the past, in 2020, 2021, the ESG segment was growing at 50% per year. 50% per year. And then at the time I was working in Paris at an ESG fund. So I am very well aware how the ESG industry is working. Like, I have had many discussions with professional money managers, with clients, and I know how optimistic people were back in the days. And a lot of clients asked for ESG reportings, ESG risk monitoring. Yes, and you had a lot of demand for these products, and this is why MSCI thrived. You had a segment, ESG segment, growing by 50% per year. And guess what? ESG is not working. People want to focus on financial returns, so clients don't want this anymore. So the growth rate went down and down and down and down. And now on a quarterly basis, from 50% growth, 30% growth, 20% growth, 10% growth, and now 7% growth. Nobody wants your stuff. Okay, so talk about a failing segment. Now you are maybe wondering, why don't they sell this segment? It's a bad segment. Why don't they get rid of this segment? No, that's part of the philosophy from the CEO, Fernandez. He doesn't want to get rid of this. He thinks the ESG segment is extremely important for the future, and he thinks the sustainability part of investing will be key for the next decades. So I don't think they will want to sell this division. Unlucky for margins, but this is life. Okay, so can I really compare the past 10 years of growth? No. But for the past 4 years, you have a growth rate on average of 28%. Of course, it will disappoint. Nobody wants the ESG stuff anymore. So, the growth rate for the ESG segment is 7-8%. Okay. And the margins went from 36% adjusted EBITDA margins to 38%. So you get what? 2 points, 3 points more. Good. So they said they would improve efficiency. Now this is working. This is a green flag. Okay. Sustainability are up. Operating revenue up. I'm expecting bad stuff for the ESG segment, by the way. I'm expecting a continued deceleration in ESG revenue growth. I'm expecting this segment to grow 4 or 5% in the future, but I'm expecting them to squeeze all the margins, to squeeze all the juice they can from this segment. So far, they are doing this, and they were also doing this in Q2. I made a video about this 3 months ago for the Q2. So they are walking the talk here. And then the remaining segment, the segment we don't care about, it's all other private assets. They have a little bit of everything here. They do acquisitions. I don't like the acquisitions they've made before in the past. I don't like what they are doing here in this segment. Anyway, seems like they like it. It's alternative investing. And this is a segment that was growing between 5 and 10% if you don't take into account the acquisitions. Okay? Please don't consider these big spikes in revenue because it's because of acquisitions. Organically, without acquisitions, this segment was growing 5 or 10% per year. What has been the growth rate for this quarter? You grow 10% per year. Okay. At the same time, what about the margins? Margins went from 25% to 27%. Good. Efficiency. So they have four big segments. The index segment was growing in line. So out of four segments, the index segment is fine. The analytics segment, they failed because they wanted efficiency. You don't have efficiency. You have lower margins. For ESG, yes, you have better efficiency. For private assets, yes, you have efficiency. So out of four segments, three delivered good returns. Three showed very good execution. One was quite bad. One, the analytics segment was bad. Let's say it was bad. I wanted more margins here. If they had improved margins here, the stock would be up 15% today. Okay. What's next? About the balance sheet, okay, as I showed you before, MSCI is known for being asset light, but they are using debt to supercharge investment returns, because in the past, MSCI was not running with a lot of debt. They said, we want to play safe, we are efficient, this is fine. And then you had an activist investor called Value Act that invested in MSCI in 2014, 2015. They took 2 or 3 seats in the board of directors, and Value Act, the activist, said, come on guys, come on MSCI, you can do more buybacks. You have a resilient asset-light business model. Why don't you fuel these returns by having a little bit of debt so you can do more buybacks, levered buybacks? Well, this is exactly what the company has done. And as you can see here, in 2014, a big ramp up in buybacks. 2014, the company repurchased 5% of their shares in 1 year. In 2015, the company repurchased 10% of their shares. You see the big green candle here. In 2016, they repurchased 9% of their shares. And over the past few years, they repurchase, when the stock is down, they repurchase a lot, 7%, or back in 2022, 3% of their shares. So that's part of their philosophy to do buybacks, and the debt level is manageable. You have what? Net debt of $5 billion, and you generate $1.5 billion of free cash flow. So because of the resiliency and the runway of the business model, you have no difficulty with this balance sheet. So, balance sheet, the cash was $400 million. The debt was $5.6 billion. So you have net debt of $5 billion. You do debt minus cash. Okay. The total debt to adjusted EBITDA ratio was 3. MSCI seeks to maintain total debt to adjusted EBITDA in a target range of 3 to 3.5. I want to stop here and make a comment. Because, how can I show you it there? 1 quarter ago, in Q2 2025, you had a report. Similar report. Let me show you full screen so you see very well. And you can scroll down. During the balance sheet part. Where is it? Balance sheet. They said last quarter they had some cash of $300 million. They had a debt of $4 billion. And the total debt to adjusted EBITDA ratio was 2.5. The next line is very important. The next line is MSCI seeks to maintain total debt to adjusted EBITDA in a target range of 3 to 3.5. Now, in Q2, they were at 2.5, but the target range is 3 to 3.5. Literally, the company was telling us, shareholders, we are under leveraged. So, I made a video about this a couple of months ago. You can check on my channel. I said, I'm strongly forecasting they will take more debt to do more buybacks because now the stock is cheap. Guess what? You wait 2 months and it is happening. As I showed you before, the Barclays conference, they issue more debt. Oh, come on, it's not loading. I don't know. You wait 2 months, they raised $1 billion more debt, and now they're doing $1 billion more of buyback. $1 billion of buyback. So you had the signs before. The only difference is some people can cross-read things and interpret all the signs to make an informed decision, while other people are lost in the noise. And this is very important, and I say this for a lot of companies. as you probably know, I have the investing coaching program. I help people understand the financial statements to make an informed decision, avoid red flags, avoid the traps, so they can compound their wealth at a good return and outperform the market with a risk-adjusted good performance. A lot of them come with problems. Most of my clients come with problems, and one recurring problem is too much noise, too much information. What is important, what is not important? Well, this is a clear difference from the people that are underperforming the market and they are completely lost because they don't know how to interpret this, and the guys that are doing 20-25% per year because they understand what is important and what is not important. And everything that I am showing you in this video is this difference. How to really interpret all the data to only focus on what is important so you can make an informed decision and you can benefit from quality companies when they are cheap. You had the signs of this. You had the signs of they will take on more debt. The interest rates are dropping. The debt is getting cheaper. Obviously, they will take advantage of the debt. If you look at MSCI and their debt level for the past few years, the company literally took on more debt for the past few years since 2015, exactly as I told you for Value Act and the activist. And then interest rates went up. So in the middle of 2022, they stopped taking more debt. They say, we stop. Now interest rates are no longer zero. Interest rates are at 5%. We stop taking more debt. Let's just be flexible and wait it out. Well, they have the discipline to wait 3 years, and now interest rates are trending down. They will take more debt, and I'm strongly forecasting they will continue to take on more debt because now, as you can see from this report, the ratio is 3, but the range is between 3 and 3.5, which means they have a little bit of room to grow. They can take more debt if they want. It's within their guidance. Maybe this is what they will do to fund buybacks. Maybe if the stock drops, it's 100% sure. I have no doubt. If the stock drops in the next 3 months, they will take again more debt to do more buybacks. I can bet a lot of money on this one. Okay, so they talk about the new debt they issued, $1 billion of 5%. As you go by, the percentage will decrease. And they don't need to pay any debt between now and 2029. So it's not as if you take on more debt and you have to repay the debt next year. No, you have 4 years to be helped by inflation, and then you will repay your debt. So I will talk about the slides later. In August, blah, 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 we have no debt, Capex and cash flow, Capex. Capex is not that high, actually. The Capex for this company is not that high. I created a custom index, a custom metric, for MSCI to have the real Capex. Am I doing it properly? Yes. This is the percentage in Capex. Oh, great. Okay. How can I explain to you? I can explain this. Let me stop a little bit and make a point about Capex because some financial websites are wrong. Now you are hooked. Why are they wrong? Am I missing something? Who is wrong? Okay, so you have the cash flow statement for MSCI. How are the cash inflows, cash outflows for this business? And you can see here, that's the income statement. What a professional investor. Balance sheet. Here we go. So this is a cash flow statement for the business, and you have this line for the cash flow from investing activities. If you don't know what I'm talking about, I have made plenty of videos about how to understand financial statements. Don't worry. You have this line called capitalized software and development costs. So I see this as Capex for software. You invest in more AI software, AI tools. And you have this line, capital expenditures. You see 2 lines. On a year-on-year basis, the Capex has been cut by half. Last year, the Capex was $6 million. This year, it's $4 million. Not cut by half, but cut by, 60%, 40%. Yeah, that's 60% of what this is. Anyway, it's down. And the software Capex is increasing a little bit. If you go to Fiscal AI, you click on ratios. You want to show the efficiency. You go to capital efficiency and you click on this line, Capex to operating cash flow. You will say, oh my God, it's so low. It's only 1%. What this orange line shows you is what is the amount of Capex compared to operating cash flows. And you see that it was 1%. 001 means 1%. So 1% of the operating cash flows are used to do Capex. Okay? Or something like this. Like Capex represents 1% of the operating cash flows. And now you can see it was 4% increasing recently. This is for the past 10 years. For the past 10 years. And since COVID, this line was increasing after all. 3%, 4%, and now we are back to 1%. So maybe you are telling yourself, oh wow, they have almost zero Capex, life is good. Well, Fiscal AI is not taking into account this line, the software Capex, that is 4 or 5 times bigger than the real Capex. So Fiscal AI is wrong. So I adjusted and created a custom metric to account for this. And this is what I got. You have this. Instead of having 1% in orange, you have 6% in blue. As you can see, the two lines were very similar before COVID, before 2019. And then they did more, MSCI did more and more investments in software Capex, software data. As I told you, they created in 2021 a mega platform called MSCI One in 2021. And so they invested massively in a new software infrastructure. So it's normal to have big Capex investments for software. So you have a discrepancy here. You have a gap here. Anyway, what I want to show you is over the past few quarters, I had a worry. I had a worry because the line was trending up. And I told myself, okay, the real Capex is this line, the normal Capex plus software Capex. It's not 1% of the revenue or 3% of the operating cash flow, sorry. It was trending up from 5% to 8% to 10%. This was what I had in Q1, 11%, Q2, 10%. So that's the percentage of Capex as the real Capex as a percentage of the operating cash flows. Sorry if I'm not clear. I will try to repeat so everybody can understand. That's a little bit technical, and this is why you also clicked on this video, right? You don't want to go narrow. No, you want to go deep. You want to go deep, and this is the only video you need to understand MSCI. So you will know everything. Okay, I don't know how long this video will be. I don't know if you have a limit for the YouTube videos, but I want to take my time because I have received a lot of comments when I did this kind of exercise for Evolution AB, like 1 week ago, and seems like I can help other people with other companies. So, and I like doing it. I like doing it so you can understand the process behind the analysis, etc. By the way, if you like this format, please leave a like, please subscribe, leave a comment below. Just leave a good comments. I know YouTube is tracking the words people are using, so please make big comments so the algorithm recommends this this video to other people. Thank you very much if you do this. You can join this channel to become a member to the channel if you want to continue the work, so you can have access to live sessions only for members, and we can talk more freely about everything during the live session. So you can become a member, and yeah, let me continue. So I had a worry saying the real Capex of the company is increasing. What if MSCI is not so asset light anymore? What if they are ramping up the Capex? I don't want this. I want minimal Capex. I want massive buybacks, massive dividends. Well, seems like this quarter, it's September, this line collapsed from 10% Capex to 6% Capex. What are they doing? What is changing? This is a good question. From what I see here, this line is still trending up and the Capex is completely down. Why is the Capex line down? Is this the only reason? Yeah, I suppose. The only reason why this line is going down, and because the Capex is down is because of this. The Capex is down. Do you have comments on why Capex is down? No. 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 Anyway, they don't provide data on why the Capex was down massively year on year. Fair enough. That's another question mark. So let me not put it in red, but let me put it in a... That's a question mark. That's not even a yellow flag, but that's a question mark. Let me put it in yellow. What is happening over there? Do you expect a rebound in Q4, or do you really expect something that is dropping down for the coming years? Nobody knows. Nobody knows. Let me continue. This was for the line Capex. Capex and cash flows. Okay, free cash flow was up. Okay, very well. Share count. We talked about buybacks. Well, they delivered. The number of shares outstanding is down 3% year on year. As mentioned before, they authorized a new stock repurchase program for $3 billion. Let me show you something. If you look at the data, the buyback program, this quarter was the biggest buyback ever. This quarter, they repurchased $1.2 billion worth of shares. As a reminder, they just issued $1.2 billion of new debt. They already consumed everything to do $1.2 billion of buybacks. Exemplary. And we knew this because of the conferences from the CFO in September, 1 month, 2 months ago. They literally said, we think we are cheap. The stock is down from Q2. So we are doing buybacks. But how much we didn't know. Now we know. They did everything. 100% of the debt was used in 1 quarter. And as you can see, for the past 10 years, this is their biggest buyback ever. It shows how bullish people are, the management team is, for their stock. In absolute terms, that's the biggest ever. But you have to account for the percentage. And I did this exercise, so you don't have to. This one. Okay, this is what we have. In blue here, this is the diluted weighing average shares outstanding percentage change. How much of the shares are going down? Well, it is not good English, but you understand me. What is the growth rate of your buybacks? How many shares are you buying back? Well, in 2015-16, they were buying back 10-14% of their shares. Massive buyback program I showed you before. Back to back, they repurchased 10% and 10%. In 2018, the stock dropped, they repurchased 5, 7, 10% of their shares. And in 2022, they repurchased 3-4% of their shares. Now, the buyback program is accelerating and they are repurchasing 2.7% of their shares. So it's a big amount. It's $1 billion. But because the company is growing at the same trend, you have to account for the percentage change. So it's not that huge, actually. It can be quite appealing, but it's not huge. They are repurchasing 3% of their shares. Okay, so I wanted to show you this to not get too excited. It's their biggest buyback ever, so it shows conviction. But yeah, don't get too excited. I want to show you something else. I want to show you the percentage of buyback. The buyback as a percentage of operating cash flows. Yeah, nah, this video gets technical now. This, how can I explain? This line in green shows how much is the buyback program compared to the operating cash flows. What it means is now for the latest quarter, September, the buyback amount accounts for 272% of the operating cash flows. Okay? It is the first time it is so high in 3 years. So more than double, more than triple of the operating cash flows were used to do buybacks. It is the first time in years we have this. In the latest quarter, it was 40%. So 40% of the operating cash flows were used to do buybacks. now it shows conviction. I mean, this is an absolute green flag actually. It shows absolute conviction in the management team. They say the stock is cheap and they act accordingly. They do massive buybacks. And this is not the first time we have this phenomenon of a big spike. We did this in March 2022. The stock was cheap. Actually, can I play around with the stock price? Okay. Oh, quite interesting. Fair enough. In Q1 2022, in March, you had a spike in this metric. It went up immensely. Guess what? It was the bottom for the stock. And after this, because the stock was so cheap, they did massive buybacks and the stock went up. Last time they did this was in Q1 2020. They repurchased 300% of the operating cash flows as buybacks. It was the bottom of the COVID. So the management is acting with discipline and flexibility when it comes to buybacks. They are not doing like FICO, for example. Fair Isaac is repurchasing shares, or AutoZone, or really, they are repurchasing shares every day for years, regardless of how the stock price is doing. Well, MSCI is not doing this. They are timing their buybacks. They are doing buybacks only when they think the stock is cheap. One time here, twice here, a third time here during COVID. Another moment was when the stock price dropped in 2018 because of China, and it was the bottom. So they are pretty good at timing the market when it comes to their stock, timing their stock. Last time was here, it was the bottom. So yeah, it's actually bullish. It's a green flag to see this. So you want to compare the buyback, the percentage of the operating cash flows, but you can also do this exercise for the free cash flow. You see the same chart. And for the revenue, same chart. The only times in history this line was very high was this quarter, the first quarter of 2022, and the first quarter of the last quarter of 2018. Every time it was the bottom for the stock. I don't have a crystal ball, right? I don't know if this is the bottom, but it sounds like a bottom. It feels like a bottom. It tastes like a bottom. So maybe it's a bottom, but I'm not sure 100%. It shows a lot of conviction. Okay, let me continue. So yeah, don't get too excited with the new buyback program. The new buyback program is $3 billion, so that's 7% of the market cap. They will continue. They will continue to tap into the debt market. Dividends, we don't care. My coffee is getting cold now. About the guidance, they improved the guidance a little bit, but a tiny bit, so nothing crazy. I think MSCI wants to sound good, appealing to shareholders. So I think they are cheating a little bit and playing around with some numbers so investors can say MSCI has improved their guidance. Okay, the operating expenses are up a little bit, a tiny bit, but nothing really massive. Adjusted EBITDA expense up a tiny bit here. You have an effective tax rate that is a little bit down. You have Capex a little bit up. You have net cash provided by operating activities a little bit up, and free cash flow a little bit up. You are tweaking some numbers here and there to be a little bit more appealing. This is maybe what is important, the effective tax rate. In the past, they expected a tax rate between 17% and 20%. Now they expect between 16 and 18%. I'm talking about the tax rate because it will be important later. And I think this is pretty much it for the report. I think we can move on to something else. No. Yeah, the biggest buyback program. This is huge, $1 billion. Okay. And we have checked this already. We have checked this, the index. Okay, well, this is the only video you need to understand all the segments, all the cross-reading, all the conferences. Boom, that's it for the report. Now let me talk about, this is not finished, guys. Leave a like if you like it. We'll talk about the slides. After this, we'll talk about the Google Sheet. It will be faster, Google Sheet, but I want to add more comments on this one. And after this, we'll look at the earnings call together. And I will have the opportunity to finish my coffee. So, about the slides, let me scroll down a little bit because I want to highlight a few points that were important last quarter. So let's see if this is important this quarter. You have 40 slides, so let me scroll down and we can start. As you can see from this first slide, MSCI is focusing on what is important. Revenue growth rate of 10%. This is boring. They are doing earnings per share growth of 16%. They are doing buybacks. This is boring. Let me continue. This is important. This slide is important, and I cannot say how important it is. If you check my video for the second quarter of MSCI, this was another reason why the stock was down 8% during the day of the earnings report. Because this line was negative. The recurring net new subscription sales by region. This was negative and people didn't like this. In the latest quarter, this line was plus 7%, so you have no improvement here. But this was negative and people didn't like it. Anyway, seems like last quarter, investors were not happy because the recurring subscription run rate by region for Americas, it was only plus 7%. And people said, oh, it's low. But now they are happy again because it is not trending down. You are stabilizing at 7%. EMEA, Europe is growing 8% and Asia 8%. So nothing really sexy, nothing really bad, but nothing really good when it comes to new subscription run rates, new clients retention. I don't have anything to say much about this one. It's not that great, but it's not that bad. Actually, is Fiscal AI providing the run rate by region? I think it will be below on these slides. Is Fiscal AI doing it? I'm not sure. No. Oh, yes. Are they doing it? Run rate by region. Percentage change. Americas. I'm not sure. I think this is good. Okay, this is the percentage subscription run rate for the 3 big geographical segments. This is what you have. Oh, okay, how can you analyze this? In orange, this is Americas, trending between 8, 17, back to 7%. And last quarter, people said 7% is bad, you are trending down. Now it is picking up again a little bit. Look at this. I don't know if this is clear. Let me remove this and this. So you can see the orange. You are finally picking up a little bit from 7.1 to 7.4. This is what I say. It's not great, but it's not that bad. You could have a drop to 6%. If this line was at 6%, maybe the stock would not be up today. I'm pretty sure of what I say. If this line was decreasing massively, it is very bad for the investment theme. Similarly, if the retention rate was bad, the stock would be down. But so far, they are stabilizing the run rate in orange. What about the other regions? Europe, declining. Not that great. 8%. Not that great, actually. Okay. And Asia Pacific, declining again. Not that great. So it's good because you can stabilize your big segment, profitable segment, Americas, but not that great when it comes to this. Fair enough. So I have a mixed view on this one. I call this a real yellow flag. Let me continue. Operating highlights. We have already talked about this, the different segments. Everything is growing nicely. Some segments are growing with better margins. Significant recurring revenue model with global client base. We'll talk about this later. They have added new slides. So let me scroll down. Oh, about recurring subscriptions. Let's check this. Cash recurring income and size. Recurring asset based. So you really understand what the business model is. So that you really understand, I can show you these 2 lines in blue and in orange. In blue, that's the recurring part of the business model, which means 70% of the business model is recurring. If you have a recession, if you have a problem, if you have a stock market crash, 73% of the operations will not be impacted. and only 25% of the revenues will be impacted. And as you can see, in 2022, this went down accordingly because less important because you had the stock market that was going down in 2022. Now the stock market is going up, so this orange line is going up. Fair enough. I will explain my point later in a couple of slides. This is what I said a few minutes ago. If you have a stock market crash, only 25% of the revenue will be impacted. If stocks are dropping by 50%, MSCI is not dead because 70% of the operations are recurring. Okay? Let me continue. Emerging growth opportunities. Yeah, not important. This is the financials, operating revenues. Let me scroll down. We have already talked about everything here. Organic, client-based, average AUM. Markets are trending higher, so the AUM is going up, obviously. Period and point basis fee. Oh, you have the fee. Okay, never mind. I thought I just forgot we had the point. So if you remember correctly, I don't know, like 1 hour ago, I said, where is the investor relations? I said in the report that, where is it? What about the index segment? This, for the index segment, you have more AUM that was partially offset by a decrease in average basis point fees, so the take rate. And we said this will be a headwind in the future. Well, we have the data from a percentage, a royalty of 2.44 to 2.43, 2.41. Wow, massive decrease. So you have room to fall. You can go back down. I would love to check this for the past few years. Do you have this on Fiscal AI? I'm not sure. For some companies, you have the take rate. For some other companies, you don't have it. How do they call it? Period and basis. We have it. One, I love Fiscal AI. Please use Fiscal AI. I mean, this is so great. For the past 10 years, since 2014, in the past, the royalty take rate, like MasterCard or PayPal, it was 3.39% of fees. And now it is declining to 3%, to 2.5%, to 2.4%. In the future, it will decline, and you have some videos on YouTube that are talking bad about MSCI, saying it's a risk, and I agree with them. It's a headwind in the future. This is the world we live in. We live in a world with the digital age. You will have more competitors. This trend will continue in the future. That doesn't mean MSCI is not a buy now. It's just the way it is. So they will have a declining take rate in the future, but it will take some time. So from 2.4, it will decline to 2.2, to 2.1, but not now. Maybe in 5 or 6 years. In the meantime, AUM will grow immensely. So, okay, fair enough. Fair enough, the quarter end AUM is up plus 26%. Markets are at all-time highs. You have an inflow of money everywhere. The Chinese stock market is high. Geographical exposure, market change. Yeah, they manage more money linked to MSCI because markets are going up. Developed markets, market changes, US. Okay. Market movement and momentum in cash flows continues. For the past 15 years, almost 20 years, the AUM CAGR, compound annual growth rate, has been 19%. I love this slide. It shows you how consistent and reliable the growth is. You had a couple of instances where the AUM declined and you have explanation. I love this slide. It shows how they love their shareholders actually. You know if a company loves their shareholders, if they do buybacks, for example, or if they explain in very simple words with a long track record, like big charts. Well, you have a huge track record since the IPO. You have the explanation. You have all the data available here. As you can see here, the AUM year-on-year change is dropping when the market is dropping. in 2022, the AUM was dropping because the stock market was dropping. Now markets are up, so the AUM is up. Let me continue. The run rate from listed futures and options. Options, I don't know if this is really relevant or if this is little. I don't believe this is a big part of the thesis, so I have nothing to say here, but this is dropping. For some reason, I don't know why, but this line is dropping. A run rate from listed futures and options linked to MSCI indexes. Is it important or not? You have $50 million. I don't think this is relevant. And you have 20 million contracts, futures and options volumes linked to MSCI indexes. This is trending down. Maybe this is a future yellow flag. I have no opinion about this one. I don't know. Okay. Very good. Let me continue. They talk about their balance sheet. As I told you before, they are doing more buybacks. They have a ratio for the targets of their leverage versus the adjusted EBITDA, and you are on the low end of your target, like between 3 and 3.5, and you are at 3 right now. And they issued more debt. Strong balance sheet provides optionality, and the next maturity is not until 2029. They have to pay the debt, yes, but in 4 years, so we don't care about right now. Inflation will erode the absolute amounts of the debt, and they will have to repay their debt massively in 2030. So in 2029, they will have two choices. Either they repay their debt and they deleverage, so all the cash flows will be used not to do buybacks but to repay the debt, or they will just pay the debt and take more debt, like new debt, and just continue to reschedule the debt. Maybe they will do this in the future. As always, disciplined and consistent approach to capital deployment. They always say the same thing every quarter. The triple crown framework to evaluate internal opportunities. They don't want to do mergers. As always, I'm coming back to the conferences at the beginning of 2025. They don't want to do acquisitions. This is not in their plans at all. Coming in this quarter, I didn't expect one acquisition. They didn't do any acquisitions. And for the full year guidance, I already talked about this one. Okay. Let me scroll down because you have a few key information here. This is key operating metrics, the year-on-year recurring subscription run rate growth. What you can see is organically, it's in green. This is trending down, and seems like the downtrend is stopping for 1 quarter. I'm not getting too excited here, but people that are bearish about MSCI said these lines are dropping, so it will continue to drop in the future, and the green line will go from 9 to 8 to 7. What if it goes to 6 and to 5? Well, it seems like they are stabilizing the downtrend right now. Another good sign. Maybe they are executing, maybe they will disappoint later, nobody knows, but so far they are not going down, more down than 7%. And this is important. This line is also the reason why the stock is up massively, 8-9% today. The quarterly retention rate trends, because as you can see, you have a lot of seasonality in the retention rate. You want this to be as high as possible. And in Q1 2024, it was down from the Q1 at the time. Q1 2023 was 95%. Q1 2024 was 92%. Big decline. MSCI dropped 13% in 1 day just because of this. And this was just an accounting change because 2 clients merged. So in terms of numbers, you don't have many clients, you have fewer clients, so that tweaks and that changes your retention rate. But it seems like people don't like to do the work, so they only look at this chart and they say MSCI is dead and they sell the stock. Well, guess what? It was a beautiful investment opportunity, because if you had done the work, it was this. It was here in April 2024. If you had done the work, you would have seen this decline in retention rate. You would have seen it's just an accounting trick because 2 clients merged, and you would have bought the dip here. Guess what? It was the local bottom. And guess what? The CEO, Fernandez, bought 2 days after the report in April. So the CEO is buying the dip. What are you doing? Guess what? Fun fact. Last quarter, in the second quarter of 2025, the stock, MSCI, dropped 8% in 1 day. 2 days later, the CEO, Fernandez, bought the dip. What were you doing? I know I bought the dip. I bought the dip here, like 1 day after the report. So I bought at a better price than the CEO. Well, this is funny. Let me continue. Because I want to talk about the new retention rate. People say, yeah, it's going down. Fun fact, you have plenty of fun facts in this video. I don't know if you like it or not, but I just really enjoy studying MSCI and any other business I have in my portfolio, like this kind of deep level analysis for every stock I have to know what is important, what is not important. And I love having fun facts to know the culture of the company and all the investors around MSCI. And I have a couple of names that come in mind. Short sellers that are short MSCI, that are bearish MSCI. And in the second quarter of 2025, can I show you or not? I don't know if I can. Anyway, the retention rate here dropped from 95% to 94%. And the short seller said it's going down on a quarter-over-quarter basis. This is a very bad report. And even on a year-on-year basis, if you compare the second quarter of 2025 to the second quarter of 2024, you go from 94.8 to 94.4. So MSCI is dead. I mean, this is the analysis you're betting against if you are bullish. Yes, I mean, you go from 95 to 94. I see this as an extremely good retention rate. Anyway, more than 90% is extremely good. I don't care about small seasonality fluctuations, but apparently people love it. So yeah, very, very interesting. And now the quarterly retention rate is trending up again. In Q3 last year, it was 94.2, now 94.7, and people are cheering up. I don't cheer at all, guys. It's 94%, 95%. I don't care. It could be 93%, 92%. I don't care at all. It's more than 90%. It is all I care about. If we go below 90%, this would be a massive red flag. But now we are just playing with some numbers. This is for kids. So it's a good sign, obviously, but it's not the beginning of a new age. Now about the index segment. Every segment will have a subscription run rate and an asset-based run rate. So in blue, for the index segment, so everything that is linked with the MSCI World Index or custom indexes, you have in blue the asset-based fees run rate growth. When markets are going up, like in 2021, the blue line is up, plus 40%. When markets are going down, like in 2022, the blue line is going down, minus 13%. When markets are going up, like in 2024 and 2025, the blue line is up plus 20%, plus 17%. Very easy to understand. Now about the subscription run rate, so something that is not linked with the stock market, you have plus 11%, plus 13%, plus 9%, plus 9%. Stable, boring. This is what I love. You don't want the green line to go down. For the analytics parts, same thing. Stable. I mean, this has been averaging 7% for 2 years. Stable and boring. You don't grow that much. This is what I want to see. For the ESG part, as I told you before, and I have showed you before, in the past, during COVID, oh, it's raining right now, you had a growth rate of 50%. Now it is only 10%. And I couldn't care less if it goes to a growth rate of 5% or zero growth. You want efficiency and margins. I don't care at all if it goes down. So it will go down eventually. Literally, the management is saying, we are leaving this segment for dead. So the ESG segment is left for dead. You just want to squeeze the margins, but this is not a growth opportunity no more. They will not get rid of the segment, but they will not invest massively in the segment. They will just fire people, get more efficient, increase prices, and that's it. And for the private assets, we don't care. Okay, stable, we don't care. This is not important. This is not important. This is the guidance, the targets for long-term targets. Nothing will change. And this is the appendix. And at the end of the appendix, you have new slides. I've seen nobody on Twitter or YouTube talk about this. This is unfortunate. And this is why you're here. You have new slide. Either the slide is new or I'm completely crazy. Let me check on Q2. Maybe I just have bad memory, but I don't think this slide was... This is the slides for the second quarter. If I scroll down... No, I don't have this slide. I don't... The slides are ending with the appendix and the white slides. And now, for this quarter, the third quarter, you have the white slides and they added new slides. Oh, another quick story for you guys. You are probably aware that Warren Buffett is the best investor of the world, of all time, the god of investing. He has two lieutenants that manage the portfolio of Berkshire Hathaway, Ted Weschler. Very few interviews of these two investors. Todd Combs, in an old interview, mentioned he was asked, what is the most important financial statement in your analysis? How are you so good at investing? What do you check? And he said, the reports I like the best are the, how do you call this? The delta financial statements. Meaning, what is the delta? What is the difference between 1 year and one other year? What is changing? Maybe if you look at the annual report of last year and the annual report of today, this year, for a specific company, maybe you have a new risk section that is added. This is your delta, something that is added. It raises the question, why is this new risk mentioned? Maybe there is a red flag here. Maybe there is a hidden risk that nobody talks about. So you have a few websites that are giving you the delta financials. Unfortunately, I was using these delta websites, and because so few people are using these websites, they closed down. So anyone watching this video, guys, if you are an engineer, software engineer, please create this website. I will gladly promote your website on my YouTube channel to have this delta, the changes on a year-on-year basis, what changes between two annual reports. Because this is pretty important. The tone of the management, the culture of the management, they want to assess problems. Well, in the second quarter of 2025, MSCI was having problems because the asset managers, this segment that is very profitable, was only growing by 6% per year. So this quarter, 1 quarter after the problem, you have this new slide. MSCI client classification framework. Additional information. Okay, scroll down. What do you have? You have the segments, all the clients. This is new and this is great value. Zero. Nobody's talking about this on Twitter. People are only talking about the buyback program. Nobody's talking about this. I'm shocked by the amount of hate MSCI gets. How few people are doing the research and due diligence. Even if you look at Wall Street, I'm reading equity papers, research from professionals. They don't cover MSCI well. This is what I can say publicly. So, MSCI subscription run rate 2024 to now. I've not read this one. I didn't want to spoil the fun. MSCI has updated its client segmentation framework in Q3 2025, so now, to enhance client services and reporting framework. If you update stuff, maybe you can cheat. So maybe you want to double check what they are saying. These client segment views offer additional insights into our strategy and reflect our sharp focus on expanding use cases and uses for our product lines. I think they want to assess the questions that Wall Street analysts asked them during the last quarter, in the second quarter. Like, you had many questions about, can you talk more about your clients? the segmentation, what are the best margins, the run rate for each client. Well, MSCI is delivering 3 months after this. Certain clients previously reported among asset managers have been reclassified. Oh, so maybe they are cheating. Maybe they are squeezing, tweaking the numbers here and there. I'm not sure. Maybe we'll talk about this during the call. Examples include, but are not limited to, certain large custodian clients of investment managers are now reported in banking and brokerages and so they are playing around with the segmentation of their client base. So they can cheat. Too bad. Asset owners include pension plans, private institutions, public institutions, and investment consultants. Others include exchanges, vendors, corporates, and advisors. Client reclassification aligned with our new framework for prior quarterly periods in 2024 and 2025 have been restated on this slide. Okay. Fair enough. So you have maybe they are not cheating. If you have a restatement here, it does not affect our gap operating segments, blah, 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 blah. So what can we check? Since the beginning of 2024, we see that the biggest segment is the asset managers, the most profitable ones, the ones that was asked about in the last quarter by analysts. What you can see here, what is that? The amount of revenue? Yeah, so 48% of the revenues from the clients are coming from asset managers, and this is declining from 48% to 46%. And people are saying, what if it goes lower? What if it goes to 45, 43, 40? Yeah, of course, this is a clear risk in the future. You don't want the blue line to decrease because this is your most profitable asset and you don't want this line to go down. Seems like for the past year, for 4 quarters in a row, you keep low at 46%. Okay. Banking and other brokerages, stable. Asset owners, stable. Hedge fund managers, stable. Wealth management, stable. Everything is stable. Okay, so I think what they want to tell investors with this new slide is how stable the operations are. People are freaking out because you have a decline in asset managers. I think MSCI wants to calm people down, saying, come on guys, it's only 1 or 2%. It doesn't change our segmentation with our clients. And you have a new slide, and this is the last slide, so we'll go to the Google Sheet after this. MSCI subscription run rate by client segment and product line. So you have more details for each segment. The index segment shows no decline for asset managers. This is everything you care about. For the analytics, you have a decline of 1%. ESG decline of 1%. And this one, no decline. Okay, I don't know how impactful this slide will be. Maybe they will talk about this during the earnings call. I don't have a clue. Maybe it will be here for Q4 and the next slides in the future. But this slide is new. So they had a problem and they are executing. They want to reassure investors. It seems like MSCI during this quarter, the third quarter, they want to calm people down, to reassure investors with this, with the buyback program, with the tone from the management, with the way they have started the report talking about issues. Literally, the first line is, we are strong with our index and analytics, and we are strong with hedge funds and banks. All the questions, all the yellow flags, the question marks for the last quarter, they want to reassure people, saying, yes, calm people down. You have a growth rate that is fine. Okay. And a retention rate that is good. Okay. Now, what I want to show you really quick is my Google Sheet. Normally, it's big enough so you can see. I have here reported manually all the lines from the income statement between the Q3 2024 and the Q3 of 2025. And now it's raining a lot. The operating revenues, as we have seen before, are growing 9.5%. The COGS are up 5%. Only this is important. Only this shows that it's an asset-light business model and the gross margins will improve. Gross margins went up from 82% to 83%. So just this shows how good of an investment opportunity MSCI is in a world with inflation. This is what I've been saying for so many videos on my YouTube channel. I believe inflation is here to stay. You will have an inflation rate for the coming years between 3% and 5% for the coming years. I don't have a crystal ball, but from what I see, I don't see lower inflation in the future. You have a minimum inflation rate of 3%. How do you invest in the stock market if you are living in an inflationary world? You want to be invested in companies that are asset light with high gross margins, with strong pricing power. How can you check if they have a strong pricing power? You check if gross margins are spectacularly high. So for MSCI, the gross margins have always been at 80% and they are improving. The costs are lower than the revenue increase is. So gross margins are trending higher. And I'm strongly forecasting for the next few years, gross margins will continue to go up. I'm strongly forecasting for next year. Let's look at the short term first. For next year, I think gross margins will continue to improve. I would not be surprised if you, again, increase by 1% more. Now about the ESG selling and marketing plus 12%, that's an expense. So you are growing your expenses by 13%. So more than the revenue. I think this line is up because they want to grow their index segment. They hired the new lady to get more clients, to reward more salespeople, so you have more incentives. This is what I think is happening. So more selling and marketing costs, more research and development costs, 16%. Research implementation of AI. What is really interesting is, yes, the R&D costs are going up, 16%, which is a lot, by the way, but the general and administrative costs are flat. And I believe the reason why you have this big gap between the R&D cost and the SG&A cost is the 2% increase in headcount. They have hired only 2% more people. And let me do a quick recap in case you just joined this video now and you just skipped the beginning of the video. This is their lowest increase in headcount. In the last quarter, it was they hired 2.5% more people. The quarter before this it was 5%. The quarter before this was 5 or 6%. So they don't want to hire a lot of people. So with the same amount of people, they want to be more efficient, squeeze the margins, and improve efficiency and invest in AI. So they still invest in AI to improve their tools, analytics tools, but they don't want to do this by hiring a lot of engineers. They want, with the same base of employees, to just continue improving and investing. And amortization of intangible assets went down flat. And depreciation is irrelevant. It's so small. Which means the total operating expenses are up 17% compared to the operating revenues up 9%. So COGS, cost of goods sold, cost of revenue, are up less than the revenue. And operating expenses are up 7%, less than the revenue, which means you have operational leverage. Gross margins are going up, and also operating margins are going up. You have an operating income, you have this big gap, so operating income is up 11.5%. You now understand the shenanigans, all the stuff when the management team is showing you this in the report. Why is this going up? Why do you have this? Well, you now understand why the operating income is up 11%. The operating margins for this business went from 55% to 56%. Okay, you continue on the way up. Now, let me go down on the income statement. Interest income is irrelevant, is so small. Expense is up plus 14% because they have increased their debt. They recently took on more debt, so you have to pay an interest on the debt. So obviously, the interest expense is going up. Plus 15% because you have more debt. And this is irrelevant, so that means this. And if you account for the new debt, you have income before provisions for taxes of 11%. A growth rate of 11%. This is your tax rate. Tax rate is going up by 6%. By the way, guys, it is not shown here in the report, they have only guidance and etc. And I've seen nobody on Twitter talk about this again. But the tax rate for this company is decreasing right now. So in the guidance that we have for next year, they expect the tax rate to be down. But actually, I did not expect the tax rate to be down this year. Let me show you. Yeah, okay. So this is the guidance for 2025. Oh, no, it was for 2025. Never mind. In the past, they expected the tax rate for this year between 17 and 20%. Now they expect the tax rate to be between 16% and 18%. Now we are 80% on the high range. What was the tax rate for the other quarters? Do I have it? Oh, this is actually very important. I have not prepared this, but how can I show you this? It's similar to evolution. If you have the guidance for the full year, you have a guidance. I already forgot what was the guidance. The report. I want to take my time here because that's important. The guidance is between 16 and 18%. So, guidance 16, 18% full year. Now we are 18% for this quarter, so on the high end of this range. If I look at my same Google Sheet for 2025 for the second quarter, what was the tax rate? The tax rate was 19% for June. So June 19%, September 18%. Can I do it for? Yes, I can do it for the Q1 manually. And for the Q1, what was the tax rate? Not provision. You calculate it this way. Okay, on a quarterly basis. Let me double check my numbers. I want to check the blue and the orange. So 71.12 divided by 396.81. For this quarter, you have a tax rate. Oh, this is good. For the latest quarter, it shows 17.9%, which is what we have here. So this is how you calculate the tax rate. These two lines on Fiscal AI. Let me triple check for Q2. 74.19 divided by 377.84. You have a tax rate of 19.6%, which is what we had. So this is correct. What about Q1? Now this is getting sexy. 42.47 divided by 331.07. Tax rate of 12.8. 12.8. Wow. They didn't pay a lot of taxes. So, if I do 12, is it a comma on this Mac or 12.82 plus this plus this, this is your tax rate. The average, I hope you are still following, by the way. I told you this video will be advanced, and this is the only video you need to watch to understand everything about MSCI. The average tax rate so far for this year is, in percentage, 16.8%. So right now they are in their range. Okay, so that tells us that okay, they are in the range. Nothing. If this average tax rate for the first 3 quarters, if it was in the 18 range, you could have expected a better tax rate for Q4 and a beat and raise. But they are inside the range, so I don't think it will be impactful. Okay, anyway, let me continue. So the tax rate is decreasing. Lower tax rate helps. And you go from an income before taxes 11%. you cheat because the tax rate went from 21 to 18. So again, you cheat 3 points. You go from 11% to 16%. I mean, it's a little bit more than 3 points, right? So the net income is growing at 16% per year. Add to this a buyback program of 3%. You buy back 3% of your shares, 16% plus 3%, that's 19%. So the earnings per share for this company are growing 19% year on year. This is how you can explain this number. And biggest buyback ever, we called it. Yes, actually we called it on this YouTube channel, saying that they will do a massive buyback program, maybe the biggest buyback program, exactly like another company I have in my portfolio called Fortinet. We called it and it happened. So yeah, we are getting pretty good at calling the buyback programs, getting into the head of the management team. Okay, so this was for the report. What I want to tell you is, maybe the tax rate for this year is low. 18% tax rate. What if... So, tax rate is a tailwind for this year, and this is the reason why the net income is so high. What if tax rate was not impacted? Because after all, tax rate can go so low, right? Maybe they will go up in the future. So what if the tax rate was exactly the same as last year? Instead of having 17, you have 21. That's a good question. So let me change this. Instead of putting $71 million, you have what? 85. Oh, pretty good. Oh, good guess. So if you put $85 million in taxes, you have the same tax rate, like 21% tax rate. If you didn't change the tax rate for this company, you would still have revenue growth of 9%, EBIT, operating income, a growth of 11%, and then you would have a net income that would have grown at only 11%. You do 3% buybacks, so earnings per share is growing 14%. The real earnings per share growth is 14%. I'm sorry for all the shareholders that cheered up because they saw earnings per share growth of 19%, but you are cheating because you are lowering the tax rate. If you don't change your tax rate, this is the real core operations of the business are growing 14%, which is still good, by the way, which is still good. In a market where the analytics segment is struggling, you have other competitors like FactSet, Moody's, S&P Global that are struggling in the analytics segment. AI will eat the software companies. Growing your earnings per share 14% is more than enough with the sustainability, etc. So that's the real operation. But MSCI is cheating because they decreased their tax rate to 18%. Maybe next year, the tax rate will be the same. So it will be very hard for them to make 19% growth rate again. Maybe next year, the tax rate will be lower. So you can again cheat with your growth. Maybe everything can happen, right? Anything can happen. Okay, I have a few comments. And after this, we'll go to the earnings call. MSCI becomes a profit machine. As I told you, as I have shown you with all their segments, they focus on improving the margins a little bit everywhere. It focuses on its crown jewel, the index segment. They hire back this great lady. You have 11% growth rate. You have stabilized margins. You get more clients inside the loop, inside the ecosystem. They focus on the index segment. And this is a key difference versus S&P Global. Over the past few months, I have received countless comments about why do you prefer MSCI compared to S&P Global. The difference is MSCI is squeezing all the juice and MSCI is focusing on its index segment. They are not doing stupid big acquisitions. If you look at S&P Global, they are doing big, stupid acquisitions. It's not me saying this, it's Dave Cantesaria from Valley Forge Capital Management, who is an investor in S&P Global, a big quality investor, an inspiration for all of us, including me. And he said in an interview from We Study Billionaires in late 2024. I'm giving you all the information so you can look on the internet. I think it was in November 2024, December 2024. Dev Kante Saria. Saria, we study billionaires 2024. I think it's this one. December 2024. Yeah, it's this one. Please check this interview if you are interested in MSCI and S&P Global. And at the end, he mentions, what is that? He mentions the fact that S&P Global is diversifying outside of the rating segment. They are doing big acquisitions with debt to focus on the analytics part. But the analytics part, they have lower margins. So you are diluting your margins. You are entering a new category with a big IHS acquisition with a lot of debt, their biggest acquisition ever, and that drags your margins down. And he doesn't like this.
North to Canada.
So yeah, you got the 50 minutes. You should be here.
Number of quality-oriented investors. Acquisition to continue to grow market share without
Okay.
for a lot of your companies. Yes, I would say core capital allocation is absolutely something that can grow in a great business. It's really unfortunate because we all know a lot of great business models, and out of either boredom or they need to smooth out earnings for Wall Street to increase their multiples, or you just simply hire a business development person and they have nothing to do. To give them a hammer, they're going to go around looking for nails. But invariably, these great businesses ruin their companies by buying into lower quality business models.
Exactly. Okay, I hope you can hear well. This is what he has to say about diversification and S&P Global.
If you already inherently own a great business like Moody's debt ratings, and you go and buy a lot of other things for your Moody's analytics business, you're ruining the business quality, the overall weighted average business quality of your company. And so it drives us nuts. And it's really quite unfortunate. FICO does not do this, so they deserve a blue ribbon for that. To date, they've not gone out and decided they want to diversify into other areas. But arguably, like with S&P Global, they have the debt ratings business, which we love. They have the S&P index business, which is a phenomenal business. Even maybe Platts, but with the IHS Markit, they bought some things where they were able to roll into other areas. But does a market intelligence, is that in the same league as debt ratings businesses?
The market intelligence segment is the analytics segment from S&P Global. And in 2022, they did a massive acquisition. I will show you to it later.
Index business? Absolutely not. And if S&P goes out and starts to make a lot of acquisitions to bolster its market intelligence business because growth is slowing there, we think that ruins the overall business quality of the company. So it's frustrating for us. You can't throw out the baby with the bath.
Yep, exactly. All right. So it's not me saying this. It's one of the best investors in the world here telling you exactly the same thing. S&P Global is diversifying because they are doing massive acquisitions. If you go to Guru Focus, you will see what I'm talking about. If you scroll down, this is for S&P Global. You scroll down, you have a lot of debt in 2022, a lot of dilution. They diluted the shareholders. They issued 36% more shares. And it drags down the ROIC, obviously. A lot of debt, the margins went down, the shareholders were diluted for something that doesn't grow much. You don't want this. And guess what? You don't have this for MSCI. So MSCI is a kind of a competitor to S&P Global. I mean, they have both index segments, but MSCI is not diversifying. Actually, MSCI is doing the absolute reverse. Instead of diversifying out of the index segment, MSCI is focusing on the index segment. They want to grow the index segment. They want to improve the efficiency for all the other segments, and we don't care if they don't grow, but they want to grow their crown jewel. This is why I own MSCI. It's like FICO. You have one key segment, and you keep it warm. You keep it warm, keep it growing, and you just squeeze all the juice here. Management shows efficiency and clear capital allocation. In the future, margins will continue to trend higher for all the reasons I mentioned before. I don't expect major acquisitions in the future. Okay, so we checked all the things. Subscription growth rate. You are having a nice retention run rate. The other segments overall are improving their margins. Not the analytics part, but the ESG and the private assets. Yes. Operating margins higher. Retention, renewals, guidance is improved a little bit. And we'll look at the call. So I have written this. Net income. Let me just scroll through this a little bit. What I was watching and what happened, I wanted more index segment, asset-based fees, analytics down. I expected, okay, private assets, okay, buybacks. Exactly as predicted. The buyback is high, and the long-term super efficient compounder thesis is fully intact. This is very true. The business keeps improving margins, earnings per share, free cash flow, while shrinking its share count. They are doing buybacks. Markets might still ignore MSCI in the short term, but fundamentals are stronger than ever. With a 3% free cash flow yield, so a price to free cash flow of around 30, and an earnings per share growth of 15 to 20%, this remains a top tier compounding setup. Personally, I hold. Yes, and this chart is very important. This is the importance of each segment. You can see in orange, that's the index segment. That's more than half of the revenues, and it is trending up again. Exactly what I told you, the difference between MSCI and S&P Global. For S&P Global, this line for the index segment is trending down, and the analytics part for S&P Global is trending up. For MSCI, it's not the same. The analytics part, the blue part, in terms of importance when it comes to the revenue, is trending down from 30% of the revenue to 25% of the revenue to 22% of the revenue. It's not important. And if you do this, if you continue these trends, it will improve your overall margin profile for MSCI. So MSCI will get more efficient in the future. This is also why I'm buying MSCI, and I've seen 0 videos about it on YouTube. Okay, now take some coffee, take some water, and let's listen to the earnings call. I'm so excited for the earnings call. Wonderful.
Day, ladies and gentlemen.
Okay, I hope the explanation was clear. Please tell me if I go too fast. But I wanted to give you a clear picture of everything that was happening. Normally, that's very close to the microphone, so you can hear very well. I don't know how you can speak with the microphone and at the same time record your audio from your computer. So I'm doing this and recording everything with my mic. I have to check this.
A question.
Let me skip to where it's important. Blah blah blah. We have issued. Be careful what we say. We make forecast, and we can start. It's a call off 1 hour and 18 minutes, and then we add more comments along the way. So this video will be long, but you will have everything. Okay?
With that, let me now turn the call over to Henry Fernandez. Henry?
Thank you, Jeremy. Good day, everyone, and thank you all for joining us. In the third quarter, MSCI delivered strong financial and sales performance that highlighted many of our underlying competitive advantages. We had organic revenue growth of 9%.
Okay, come on, let me just not waste your time. So we have already talked about this. Okay, we did some buybacks. We do more buybacks. We have some debt. In my remarks, I discussed a few biggest themes, starting with their index franchise. We underscored the depth and versatility of our index franchise. We are delivering good results. Oh, this is important. This is good. This is lovely. The management team is talking about what was bad in Q2 right away. I love it. You don't have a lot of management teams that are doing this. Literally, the stock was down in the second quarter of 2025 because of some reasons. Well, they start the call with these reasons now in the third quarter. For example, I told you in the... How can I show you? In the slides for the second quarter of 2025, the markets from Americas was down. People were not happy and saying, oh my god, you have a clear deceleration of this market. Well, in the first remarks from the CEO, they talk about the index segment, versatility, and also MSCI achieved recurrent net new subscription sales growth of 27% in index, including 43% growth in the Americas. This is great. They are rebounding so fast. This is good. Okay. Anyway. What are you talking about 43%? It's 20% here. Anyway. Oh, it's an overall. Okay, fair enough. We are now have a very long run rate. The ongoing adoption of the MSCI indices showcase the investment community, blah, blah, blah. In analytics, we are still growing. We launched some models. Oh, you have some new information. So let me start the call here.
In analytics, MSCI delivered recurrent net new sales growth of 16%, driven by strong adoption of our risk tools and equity models by multi-strategy hedge funds. Our growth in analytics increasingly supports our growth in private assets, and vice versa. Last month, for example, MSCI launched a private credit factor model powered by data from more than 1,500 private credit funds in our proprietary database. This factor model will provide investors with improved transparency and a consistent, integrated view of market risk for a fast-growing asset class. Elsewhere in private assets, we recently launched a new global taxonomy. Known as MSCI PACS, the Private Asset Classification Standard, this proprietary asset classification framework aims to bring consistent, comparable standards to private markets. Powered by artificial intelligence, this new taxonomy covers a wide range of private assets, including private companies, real estate, and infrastructure. The new framework builds on MSCI's long history as a standard setter in public equities, and investors can use it to benchmark, analyze, and communicate portfolio strategies and performance. As the last example illustrates, MSCI's innovation teams are rapidly leveraging AI models, especially on our large proprietary database, to enhance existing products and develop new capabilities. AI is allowing us to unlock significant value for clients, which will also lead to meaningful value creation for our shareholders. In addition to rapid expansion in new products, MSCI is significantly expanding our presence with newer client segments, while deepening our penetration of more established segments, which Bear will discuss. And with that, let me turn things over to Bear.
Thank you, Henry, and greetings, everyone. As you are aware, over the past year or so, I have framed my remarks on these calls through the lens of MSCI's main client segments, and I will continue to do so as we grow our footprint with newer segments and deepen our penetration of existing ones. With that in mind, as you saw in our earnings materials, MSCI recently enhanced our client segmentation strategy. Details and comparison points are available in our Q3 earnings presentation. Starting with hedge funds, MSCI delivered 21% recurring net new subscription sales growth. This was our highest Q3 ever for new recurring sales to hedge funds, with notable strength in analytics. In particular, we see ongoing strong demand from hedge funds for MSCI's equity factor and enterprise risk and performance solutions, which have become deeply embedded in many clients' investment workflows. For example, MSCI closed a 7-figure renewal deal with one of the world's largest hedge funds, in which our contribution to their alpha generation and risk management is central. We also completed a global deal with a large US-based hedge fund that will expand its use of our enterprise risk and performance tools. Our analytics solutions are now fully integrated into every aspect of this client's risk management process, including its capital allocation framework for individual portfolio management teams. The common theme here is that amid elevated levels of market volatility and uncertainty, hedge funds want deeper, faster insights into key sources of investment risk and return. MSCI is fortifying our position as a trusted partner. Turning to wealth managers, we achieved nearly 11% subscription run rate growth, driven by a balanced mix of contributions from across product lines. Recently, a large independent wealth manager in the US licensed our private capital fund transparency data to enhance client reporting on private funds. This shows how MSCI is enabling both scaled data gathering and the standardization of private asset data to provide the enhanced portfolio insights clients need. Indeed, wealth managers' growing demand for tools and standards in private markets creates a great opportunity for us. We also have a growing list of clients licensing MSCI Wealth Manager, which has allowed us to deliver unified solutions for the home office with advanced tools spanning personalized client portfolios and proposal generation, along with regulatory workflow support. Shifting to asset owners, we posted 9% subscription run rate growth, driven by analytics, private capital solutions, and index. In one of our biggest deals in the quarter, MSCI renewed our relationship with a major Canadian pension fund across our equity models and risk tools. We've also expanded our private capital solutions relationship with a US-based asset owner as we support this client's increasing demands for total portfolio solutions and performance measurement and transparency as they grow their private markets allocations. In addition, a rising number of LPs are using MSCI private capital indexes and our newly launched frozen indexes as their policy or performance benchmark, reflecting a shift away from public proxies and return targets and an increased alignment with MSCI standards. We are therefore confident that our investments in private capital indexes will help create significant value both for clients and for MSCI. Moving on to banks and broker-dealers, MSCI delivered 9% subscription run rate growth, including a record level of Q3 recurring sales. This was driven primarily by index, which also posted its highest Q3 ever for new recurring sales. Our most notable Q3 business win was a global index renewal deal with one of the largest banks in Europe that highlighted the mission-critical role of MSCI index dataset in their trading, index rebalancing research, and product creation capabilities.
And now the most important segment, the asset managers.
Turning finally to asset managers, we achieved subscription run rate growth of just over 6%. MSCI is working intensely to increase our growth trajectory with this segment, and our efforts had a meaningful impact in Q3. In fact, we delivered our highest Q3 on record for new recurring sales to asset managers in index, which helped drive 11% overall new recurring sales growth with asset managers across MSCI product lines. For example, we landed a 7-figure deal with one of the world's largest asset managers in support of their wealth management strategy.
Okay. If you look at the Q2, second quarter, a reason why the stock dropped was the asset managers, MSCI subscription run rate growth held steady at 6%. And people said 6% is not great. What if you go to 5 or 4 or 3%? It's not good at all to have your asset managers segment. It's called active asset managers. So people wanted more growth here, and what the management is basically saying in the third quarter is we are not going down, it's still 6%, but we are doing everything we can to make it grow again. Yeah, I would love the management to show us what they are doing. If you go to the slides, the asset managers are the most important. This is half of the revenue coming from asset managers. What they are saying is this is only growing at 6% per year. I'm not convinced. MSCI is working intensively to increase our growth trajectory with this segment. Yeah, of course. I mean, you must do this. And our efforts had a meaningful impact. Well, no, because you still grow by 6%. So no impact. In fact, we delivered the highest Q3 on record for new recurring sales to asset managers in index. Okay. New recurring sales. So they are getting more aggressive in getting more clients. Okay. Good luck. Wait and see for this one. I'm not convinced.
MSCI is providing financial advisors with ever more sophisticated analytics tools such as stress testing, which helps them grow their business and support their own clients. We also completed a large deal with a top European asset manager to help them develop a centralized program for their risk, performance factor, and sustainability analytics across investment teams in different global locations. This was another great example of our ability to expand and deepen existing client relationships using our One MSCI integrated solutions. Looking ahead, we are encouraged by
I told you, MSCI One, also called One MSCI.
MSCI's long-term opportunities and our ability to drive growth from recent areas of innovation and investment, all of which should help us remain the mission-critical provider of choice for clients across the capital markets. And with that, let me turn things over to Andy. Andy?
CFO.
And hi, everyone. Our third quarter.
Okay, as always, the CFO will talk about the numbers. So let me just skip this so you don't waste your time. We see strong demand, blah, blah, blah. We have already talked about the subscription run rate for everything. We've been encouraged. Oh, this is new. Okay.
We've been encouraged to see that new index products launched since the beginning of 2023 generated about $16 million of new recurring subscription sales over the last 12 months. And index retention rate remained durable at nearly 96%. In analytics, we had subscription run rate growth of 7%, driven by our highest Q3 ever for recurring net new sales. Recurring sales in analytics benefited from 29% growth in equity solutions, with strength among hedge funds in the Americas and APAC.
Yes.
Additionally, we saw strong sales of our multi-asset class analytics, most notably with hedge funds as well. In sustainability and climate, we saw 8% subscription run rate growth for the reportable segment, with roughly 6% subscription run rate growth from sustainability solutions and 16% subscription run rate growth from climate solutions. The sustainability and climate retention rate was almost 94%, slightly higher than last year's level of 93%, and reflecting the must-have nature of our tools.
It's minimal, but we take it.
Additionally, we're seeing solid demand for new solutions such as our geospatial offering, which is seeing traction across client segments, including in particular with banks. In private capital solutions, we closed about $6 million of new recurring subscription sales in the quarter, with success across client segments, including established segments such as endowments and foundations, as well as newer areas for us such as wealth and GPs. Additionally,
we don't care about this. Let me skip it. And the retention rate improved everywhere. We are getting efficient. We skilled the juice. The interest guidance is going up because we have more debt now. We have already talked about this one. We like our results. We are seeing solid momentum with new products capabilities. We want new clients. We look forward to keeping you updated. Okay, question and answer. This is where we'll get the information. Okay.
Thank you. Good morning, everybody. Henry, I just wanted to ask kind of a bigger picture question on your strategy around private credit. There's clearly a scarcity of data assets out there, which is why some of the multiples these assets are trading at seem to be very high. But just curious from your perspective, where do you feel like you have, missing, white spaces or whatever you feel like you need to fill in, and how integral is the Moody's partnership to your strategy there?
Thank you for that, Manad. We are very bullish in our work on private credit. If you step back a little bit, the new banks in America and parts of the world are the private credit funds. The provision of private credit is moving, in addition to banks, to private credit funds. That's a secular trend. There may be some ups and downs, but that's a secular trend. It's structural. And those those private credit funds need to attract investors to fund the provision of credit. There's not enough institutional capital in the world to fuel the funds that are needed, the assets that are needed in this private credit fund. So they need to attract, in addition to institutions, large parts of the wealth management industry, the retail industry, and now the 401k industry. In order for that to be viable and achievable in a sustainable and responsible way, they need the tools for these funds to demonstrate what's inside the fund, what's the credit worthiness of it, what's the market risk of it, what is the valuation of them, and so what are the terms and conditions on the underlying loans, et cetera, et cetera. So in the last 9 months, we've been very feverishly innovating on this. The first one was we created terms and conditions on, we looked at our database, proprietary private credit database. We found 2,800 funds, private credit funds that are not asset-backed, and we developed terms and conditions on 80,000 loans that are represent 14,000 borrowers in these 2,800 funds. Then we moved on to create credit assessments of these funds with the Moody's. We licensed the Moody's credit risk models. We applied it to the MSCI database, and we have launched the credit assessments of a lot of these funds, which are highly needed in this volatile environment in credit that we've been listening to, in the media recently. Then we created a taxonomy of private credit in order to develop market risk measurements of these private credit funds, and we launched the factor risk models, on them. So that's been another innovation. And now we're looking into how we develop evaluated prices in private credit in order to provide an independent, trusted source of valuation that can be basis of liquidity. So none of those things are yet translated meaningfully into high revenue, high sales, but they will. And we are incredibly needed in this space as the trusted source of information about the benchmarks. I forgot to mention that we launched.
Thank you, but I would love to have a question about another segment. Not that I don't care about the private assets segment, but yes, I don't care about the private asset segment.
I don't know, 60, 80 different private credit indices as well in the last few months to basically make people understand the private credit fund relative to a market benchmark. So that's another innovation that we did. So we are very bullish in this space, and we intend to be the leading provider of all these transparency tools.
Yes, hey, good morning, everyone. So last quarter, one of the messages was really that you're going to start leaning in more into these other new client segments outside of the traditional asset managers. Obviously, Bear gave a lot of color already in terms of the growth rate there, but can you just talk about in the last 3 months, like what you've been doing in terms of new products, but also I think you're kind of doubling down on marketing and sales. So any new...
And we have seen this, doubling down on marketing and sales. Here we go. You grow your sales about 13%, your selling and marketing expenses by 13% compared to revenue of 9%.
Any new things that we should be excited about, and when do you actually see this can make a material impact here on results? Thank you.
Okay.
Thanks for that question, Alex. The strategy is really two-pronged. We believe strongly that the active asset management industry needs us in this difficult time. But it needs us not as a cost center to them and put more pressure on their financials. They need us as a company that can help them create new products.
By the way, I believe they are saying this because over the past few years, meaningfully in 2023, MSCI was accused of price gouging, meaning you don't deliver more value for your customers, but you just increase the prices and your clients have no choice but to pay up. So clients were complaining, why do you increase your price by 10, 20% per year if the value of your services stays the same? So in 2023, the MSCI index segment improved meaningfully. They wanted to integrate more things, cross-selling, etc. So yeah, this is why they are saying this, I believe. It's not a cost center. We want to provide them with more value.
So we're very focused on creating that, especially in the active ETF space, so we can help clients do that. You saw the recent launch with Goldman Sachs Asset Management of the private equity tracker fund, which is a very innovative approach to look at our database of private equity, understand the returns and the risk of all of that, and then replicate that through public equities in a way that provides liquidity. So that's an example of something that can generate revenues for the active asset management industry. And we saw early signs of that recovery for us. The industry continues to be challenged, but if we can help them develop products and generate revenues, we're going to do very well with that. The second part, Alex, as you know, is the expansion into other client segments, and that's the reason we presented in the slides, at the end of the slides, the 2 pages of the redefinition, or not the redefinition, but the breakdown of the client segments at MSCI on the subscription part. And you can see that we can benefit significantly by helping the asset management industry because we have 46% of our subscription run rate on that, and we can benefit if we make it grow. Hedge funds are a very significant spot for us, and other parts of what we call the fast money, which is market makers and broker dealers and all of that. We've done very well there.
Yeah.
And one of the reasons is not only the risk tools that we sell, but what we have begun to realize is that MSCI has a huge ecosystem of trading around its indices. It's $18 trillion benchmark to MSCI, of which $6.5 trillion or $6.4 trillion is passive. And that has a huge ecosystem that needs liquidity. So we're developing data sets and products for all these market makers and broker dealers to help fuel that liquidity. So we believe that we have a lot of opportunities with that, with that segment, more than we even estimated in the past. So that's an area that we're focused on. Obviously, asset owners is always in our sweet spot in index and in analytics, and now very intensely in what we call PCS, private client solutions, because these are big investors in private assets, and they need more and more transparency, understanding of performance and risk and pacing models and all of that. So we're stepping up significantly our PCS efforts, and we believe that, we've seen some softening in PCS. We are going to turn the corner, particularly with the institutional asset owner space. And then there's wealth management. The wealth management part, as I said,
Okay, they are again saying we are working to improve the asset managers segment. Okay.
And then there's wealth management. The wealth management part, as I said before, needs us very significantly, because a big part of the allocations into wealth management is into private assets, particularly private credit. But they need to do it in a way that is responsible and compliant, and they don't run afoul of selling products that the individual investors don't understand. So we are gearing up significantly for a major expansion in private assets and wealth management, in addition to helping them build portfolios through what we call the MSCI Wealth Manager. So that's a little bit of a rundown of where we are. So we're very optimistic that with the significant revving up and ramping up of the new product machine at MSCI in the last 9 months, that the softness that we highlighted in the prior quarter, last quarter, is beginning to turn. Not necessarily because the investment industry is extremely bullish. The markets are bullish, but the budgets, may not be as bullish. But it's because we can create a lot of new solutions that are going to help these people solve a lot of problems, and that is that's the strategy: deepening and helping become a revenue center for the active asset management industry, and obviously sell a lot of the things into the other client segments.
Okay, I'm not that convinced about the answer, but fair enough. The track record of the company, when they say something, normally is true. I'm in a wait and see camp for this one. For the asset owners, they are still growing only 6%. I would love this to ramp up to 7% growth, 8% growth, 9% growth. But okay, they say they are innovating and they do everything they can to continue getting more clients again. Wait and see. Next question.
So much. Henry, you touched on in the prepared remarks that your teams are leveraging AI models, AI to help develop new products. And I was hoping you could give us an update on where you see the greatest opportunities to leverage AI, both on the revenue as well as on the cost sides. And any quantification would be great, but also just, what those products look like and what the cost savings opportunities are. Thanks.
Good question.
Thank you for that question, Tony. And let me start by saying that we, in the past, hadn't really talked a lot about AI, because our style at MSCI is not to talk about intentions, but to talk about actions and real tangible things. So that's one of the reasons you haven't heard us talk a lot about AI. But since ChatGPT was...
That's it. I know why the stock is up now. They mentioned AI and ChatGPT on the call, so MSCI is up. That's it. Forget everything I've said before. The only reason why MSCI is up today is because they mentioned AI, and it is sexy now to mention AI and ChatGPT, and the algorithms like it. Forget everything I've said before. This is the only reason why the stock is up today. Never mind. Okay, fair enough.
Launched 3 years ago. So ChatGPT was launched 3 years ago. We've been feverishly looking into and permeating every aspect of MSCI with AI. And the punchline is AI is a godsend to us. Let me repeat that. AI is a godsend to us.
Yeah, this is exactly the reason why the stock is up.
Because what MSCI is a company that collects large amounts of data, proprietary, unique data. AI is going to help us scale up dramatically, 1,000 times more in the next 5-7 years in data sets. Secondly, we then build in proprietary and unique investment and risk models to apply to that proprietary data. You can only imagine how much AI is going to help us do that. And then 3, we got to deliver all of that content to our clients in a way that they can consume it any way they want. So MSCI has never been a workflow software solution vendor. A lot of our proprietary sort of workflow systems like Risk Manager, Bar One, and all that, they're there to sell the content that we got. And it's almost like a necessary evil, right? So if we get the world to create, every type of access into our content by themselves, we don't have to spend any time on that or any money on that, and that's going to propel us to much higher levels. So we've been very busy in permeating every part of what we do. So if you start with the whole employee base, 6,250 people, almost 100% uses AI every single day. I actually made it a year ago a condition of employment that everyone needs to use AI tools every single day, like using a phone, using word processing or Excel and things like that. So we're very proud of that.
Okay. They will not hire a lot of people in the future. They will continue to not hire in the future. They have only hired 2% more employees. Maybe it will go down in the future. They will stop completely the hiring. They want to implement more R&D, more AI, more efficiency with their current employees. They don't want to hire more people.
Then we have permeated AI into all of our operations, especially data capture. We have basically saved hundreds and hundreds of new hires of employees by using AI in private assets, for example, in private capital solutions, in sustainability, in climate. For example, this geospatial product that we have is all based on AI and the like. So that has created incredible efficiency for us, tens of millions of dollars that are not yet, that are just the beginning of what we can do.
Wonderful. This is just the beginning. Yes, come on. You can continue to grow your earnings, your revenue at 10% per year, and you don't hire anybody. Yes, it will improve the margins.
And then lastly, and most importantly, is that we have used AI to build products. So a lot of our custom index factory is built by AI-driven methodologies. That is not a human in research as an artisan trying to build an index and it takes 6 months and all of that. No, we want to do this instantaneously using AI. So a lot of what we're launching in custom indices is AI power. As an example, the geospatial data sets that are being popular now that we're selling is all AI driven. And of course, a lot of the data that comes out of private assets and sustainability is AI driven. So again, we haven't really talked a lot about this. We answered questions, but since you asked, and there's so much focus on this, we might as well tell you exactly what we're doing. And in terms of products, I think there's somewhere between $15-20 million of products that were sold this year, out of 25 new products that are all AI powered. So that's where we are. So if anybody, this is going to be a godsend to us. Now, I cannot tell you enough that the biggest problem MSCI has is that we got so many opportunities and so little investment money, and we want to keep the profitability of the company the same.
Oh, this is strange. This is a strange comment to make. You have so many reinvestment opportunities that you are very bullish on, but at the same time, you're spending all your cash to do buybacks. If the AI opportunities were so great, you would not do buybacks. It's about your yield, right? Now you are buying $1 billion of shares with a price to earnings ratio of 30. That's a yield of 3%. In the future, you can expect more. So let's say a yield of 4 or 5% because the earnings are growing. If you had very exciting opportunities that can yield better returns, you would not do buybacks. The problem MSCI is having is they love their shareholders. The stock is cheap, they know it, so they want to do buybacks. At the same time, they are apparently getting excited for AI opportunities, reinvestment opportunities. So they say it's exciting, but they are not powering into Capex. So maybe the opportunities are not so great. We will see. I mean, they are already having $25 million of Capex, but the Capex is low. So yes, it's efficient, but as you can see, so little investment money. We want to keep the profitability of the company the same. So yeah, they want to care about the shareholders. This line can be a yellow flag to some people, but it can be also a green flag to other people, meaning the management team cares about their shareholder base. They want margins, they want buybacks. For my opinion, I prefer buybacks because that's lower risk compared to Capex. But very strange to say, they are very exciting. You see many opportunities, you have so many opportunities, but your Capex is not growing. Actually, your Capex is declining. No? The report, we checked this already. It was from $6 million to $3 million. The Capex is declining and the Capex for software is up a little bit. If you see so many opportunities, why are you declining your Capex? Okay.
So that's not an easy thing to square. But if we apply AI dramatically and we can lower our operating, run the business expenses by 5, 10, 15%, all of that money can go into investing into the change in the business. And that will create an incredible upsurge in new product development for us. That's a goal that we have for 26.
For 26? For next year. So now you have an improvement in margins. Management is clearly telling you we will have even better margins in 2026. Okay, fair enough. Next question.
Thanks for taking my question. So in the quarter, we saw really strong momentum in the index and analytics net new subscription sales. There obviously talked about some big deals there also with the asset manager and one of the largest banks in Europe. My question was much more focused on the pipeline. As we get into the fourth quarter, any comment on the pipeline as well as the sales cycle as we get into one of the highest, seasonally highest bookings quarter? Thanks.
Sure. Hey, Ashish, it's Andy. So definitely, as you alluded to, encouraged by the results in the third quarter. They've been fueled by the product innovation, the accelerating pace of product development that you've heard us talking about here. And so that's encouraging. In terms of the overall environment and market backdrop, I would say it's relatively stable. We've seen fairly consistent dynamics to what we've seen in the past. On the margin, the sustained favorable market momentum is constructive. And we have seen pretty good results in the Americas, most notably in index and analytics, as we talked about. And so we are generally encouraged by the healthy product pipeline and acceleration of product development that is supporting a strong client engagement, as Henry alluded to, both across asset managers as well as the broader range of client segments that we're targeting. And so we are seeing a relatively stable dynamic across the business. I would highlight that we do expect the dynamics we've been seeing in sustainability to continue in the near term. So similar to what we've talked about in the past, those dynamics that we've been seeing there, the pressures we've been seeing there, we expect to continue in the coming quarters. But overall, I'd say dynamics across the business are fairly consistent, and the performance is really being fueled by and driven by our product innovation.
Thank you. The next question is going to come from Alexander Hess with JP Morgan. Your line is open.
Yes. Hi, guys. I hope you're all well today. Just want to touch briefly on the non-ETF and the fixed income businesses. On the non-ETF side, there's been pretty rapid growth in the ETF revenues, I think about 19% year to date. And the non-ETF is tracking a good deal behind that. Are there any prior year sort of hurdles that are pushing down that non-ETF revenue growth? And then on a fixed income, can you remind us what the AUM is there as a 3Q, and if there was any reason why, if my math is right, there was a little bit of a quarterly dip in the run rate for that business. Just wanted to sort of unpack that a little bit. So I know I threw out a lot at you, but hopefully you can.
Yeah. Hey, Alex. It's Andy here. So on the non-ETF passive front, to your point, we can have impacts from true ups and true downs, which can skew the period-to-period comparability. And so as you know, there can be some lumpiness in any given period. We can also at times see some modest fee adjustments on client funds, and that can lead to some lumpiness in revenue and revenue recognition, as well as run rate. And so wouldn't read too much into lumpiness in the growth rate there on the revenue side. This does continue to be a very important growth area for us. We've seen some very nice new fund creation on the custom side. This is an area where a lot of the efforts that we've made on our custom index capabilities and the growing focus on customization and customized outcomes manifests itself, and we're in a unique position to help these organizations that are really anchored to our frameworks and looking to achieve objectives around our frameworks. And so wouldn't dig in too much to the revenue growth on that front. On the fixed income side, the AUM and ETFs linked to fixed income indexes, our fixed income indexes and partnership indexes is around $90 billion. And so it's been a nice growth area for us that's continued to grow. Similarly, I wouldn't read too much into revenue growth in any one period on that category. We are heavily focused on continuing to drive adoption, new innovation there, and fueling the overall AUM growth across the fixed income category, and continues to be an important area for us.
What I would add is that obviously, we see the challenges in sustainability and climate in the segment of sustainability and climate, at MSCI, as you see it. But a meaningful part of the monetization of all of that is happening in equity and fixed income indices. And it's in both, but in fixed income indices, the percentages is even more as a total. So we've been very successful in especially in Europe, in having clients come to us, and we've helped them design lower climate risk fixed income indices that they can use as a portfolio, either to give it to an institutional index manager or to turn it into an ETF. And we see that continuing. And a lot of our investment in climate is not only climate in its own, in order to sell it directly, physical risk, transition of energy, and transition risk and all of that, but it's because we believe there will be a large monetization of a lot of this climate IP in the form of indices and index investing.
Yeah.
So yes, when you look at the totality of sustainability and climate, it's a little challenge, but you also have to look at the one MSCI sustainability and climate franchise and see where the monetization is happening.
Yeah, you have cross-selling inside their own platform. Once you are inside the ecosystem, you can't get out. You have a mode for MSCI, the switching cost. It's a real pain to change your analytics provider. You have all your data inside one MSCI, so it's very costly to change. And they are integrating ESG solutions inside this platform.
Yeah, just to put a finer point on that, I think Henry hit a critical item here. That 90 billion of fixed income ETF AUM, the large majority of that is sustainability and climate related. If you look at equity ETFs linked to our sustainability and climate indexes, it's about $360 billion. And within that, about 135 billion or so is climate specific indexes. And on the non-ETF front, relating to your question, where we are seeing incredible focus by institutions and asset owners to develop specific climate outcomes, the non-ETF climate AUM is about $316 billion. So these are big, becoming meaningful contributors and helping to fuel the growth of the business.
Next question.
Thank you.
Good morning. Thanks for taking my question. On active ETFs, could you just talk a little bit more about, the economics of the products and services you provide in that area, as well as your competitive advantages? Also, if the overall AUM continues to shift from active mutual funds to active ETFs, is that a net positive or net negative for MSCI?
Sure. So active ETFs are a quite distributed category with things which are really just quite literally putting an ETF wrapper on a purely active fund, through to things which are very rules-based and which are much more like an index, or which are an indexed version of an active strategy. So the good news is that we are able to monetize across a lot of that spectrum, not merely in the index business, but a fair amount of it also in analytics with portfolio construction, et cetera. So in terms of the more specifically index-linked component, we're now up to almost 30 billion of assets in that category, and the AUM was up 10% quarter on quarter, not year on year, quarter on quarter. So we think this is an extremely attractive category. We're very engaged in it. I think it's difficult to say exactly how that will play out over time in terms of the economics and the scale, but it's growing dramatically, and it's certainly not cannibalizing at all anything we do today. It is literally new revenue, new money, new opportunity. So I think, we're very excited about it, both, as I said, from a selling of tools, a selling of data and information, and also from an index construction and licensing point of view. And, we believe that we're going to see those numbers become more important in the future.
Yeah, and as I said prior, I just want to emphasize this point, which is over the last, year or so, we've been seriously analyzing the active asset management industry, and how do we help the industry recover? How do we help the industry build competitive advantage and add value? And how do we benefit from that in increasing our growth? And therefore, one of the components, not the only one, but one important component of that is helping that industry go from mutual funds and other forms of investment vehicles to active ETFs. And we play a large role in there, as they're indicated. So this will be one of the things we'll talk some more about in the future, which is how do we regain significant growth by MSCI in the active asset management industry. This is one of the components. Not the only one, but one of the components.
Okay, good.
Thank you. The next question is going to come from Owen Lau with...
Good morning, and thank you for taking my question. I do have another question on AI, and Henry, I really appreciate your response to the previous AI questions. But I do want to ask this question from a different angle, because there has been quite a lot of conversation about how AI has negatively impacted the whole sector.
Yes.
One concern is AI investment could compress margin if that investment couldn't bring in enough revenue. How do you get the confidence that you invest in, I think you call it 15 or 20 AI projects, but that can maintain or accelerate your revenue growth? but at the same time, you can still drive margin expansion? Thanks.
It's a very good question. Very good question.
The punchline, believe it or not, is that AI will dramatically increase our margin. Really dramatically, because we'll be able to create a lot of new products, scale them faster to a lot of various participants in the various client segments, and it will significantly reduce costs to us as we use AI agents rather than humans to run. A lot of what we do at MSCI is systematic, and therefore you can systematize that with an AI agent. In terms of methodologies, capturing data, running performance, running risk, in our clients' portfolios, building models, building software.
Yeah, basically what I've been saying on my channel for months now.
So it's literally gonna chop off a lot of our operating expenses. The question is, how do we get there? And the benefit that we have is that we don't need to build large language models. We need to buy them and train them to apply to our data. So we don't have that cost. Secondly, we don't need massive data centers or any data centers. We have our own. Our clients are the ones that are running a lot of this. So we don't have to invest in chips or in data centers or in electricity, power and all of that. So we are going to be a major beneficiary of what is called applied AI to an industry, and our industry is made up of data, investment models, investment and risk models, and technology. And therefore, AI, for us, is we can build a lot more data, we can build a lot more models, and we can use a lot more technology and distribute it. So that's very important. And therefore, the investments required for us to achieve that are not significant. Let me repeat that. The investment for us to achieve that are not very significant. It's a question of retooling what you do, to be AI compliant, so that you can put a large language models on a data set that is already AI, friendly, so to speak. We need to hire, AI people, AI experts that can help us. We just hired 2 managing directors in our research operation that are AI experts in helping us build AI agentic models, investment risk and performance models, and all of that. So I do not see, a reduction of margins in order to accommodate the investment that we need to make in AI. But having said that, I don't want you all to bank the increased margins that we're going to use, that we're going to gather in AI, because we want to put them back into investments of the company to grow faster. So that's the punchline, right?
These 3 paragraphs are so bullish. Wow. The CEO is clearly telling us, public investors, we will benefit from AI without having costs with AI. We don't need Capex. We don't need meaningful cost. Everything will accelerate, will be much more efficient, and we will not need humans. So we will benefit from AI without having AI costs. So the Capex will continue to be low. The worry I had with this business last quarter, what if Capex goes up? Seems like the management team is quite confident and they want to benefit from AI. If you want to be invested in AI, you can invest in the Magnificent Seven, big data center build-out projects, HVAC companies, cybersecurity companies, plenty of opportunities, energy companies, or MSCI.
Okay, our next question will come from Scott Wurtzel with Wolfe Research. Your line is now open.
Hey, good morning, guys, and thank you for taking my question. I just wanted to go back to the asset manager end market, and it sounded like with the 11% sales growth, you're seeing some momentum there. But just wondering if you can maybe characterize if this sales momentum is around, kind of incremental demand from asset managers, or maybe more of a kind of release of pent-up demand in the pipeline. Thanks. Yeah, I would say, going back to my comments earlier, the environment's been relatively stable, consistent with what we've seen in past quarters. And so the strength that we saw in the quarter, as we mentioned, was most notable in index. We also had solid recurring net new within analytics. This was particularly the case in the Americas. And a lot of this has been fueled by us selling more to our existing clients. So we've had success upselling additional content and services, particularly within index, which has definitely been encouraging for us to see. And a lot of that's been enhanced by our product development pipeline. I would say performance with asset managers can be a bit lumpy, but generally overall we're seeing quite stable results, and we're also pretty encouraged by the solid retention rate with asset managers, which is about 97%. across the company in the third quarter. And so I wouldn't call it a trend, but there are definitely encouraging results that we're seeing with asset managers. Saw a solid quarter.
Okay.
Thank you. Your line is open.
Great, thank you. Henry or Bear, I want to ask you, there's a lot of school of thought out there with investors here the last year plus that AI will be a net negative for your company and peers out there, other information service companies, in that it'll allow new entrants to come into the marketplace and take significant share over time. I hear what you're saying about what you guys can do with AI, and I'd like you if you could just touch on more about the competitive moat you have, about why others will not be able to come in here and take significant share across any of your major verticals with this.
Exceptional question. Great question here.
Just lines at MSCI. Thank you.
No, thank you for that, Greg. I think, look, the one way to look at it is to split it into the three kind of processes, right? The first process is capturing data. The second one is applying investment and risk models on that data. And the third process is distributing the content to clients. So let's start with the last one. We are not a traditional sort of workflow software solution provider company. If anything, we've been criticized in the past that our workflow, the front end that we have is not as cutting edge, not as advanced in Bar 1 and Risk Manager and ESG Manager and all of that. And we've been hesitant to put a lot of money into that because we see that the industry is creating different ways of accessing the data, like Databricks and Snowflake and people like that. So we said, let them invest the money in that, and then we provide the content to them, and then the content does, or let the client develop their own workflow internally, which a lot of wealth management do, and we sell them the content. So that's that part. So we're not going to be disrupted there because we're not, that's not where we are. On the contrary, to the extent that there are more ways that AI can help somebody access content, we are going to be there, right? So that's that part. At the other end of the spectrum is the capturing of the data. Remember, a lot of the data we capture is proprietary. It's and it has to be accurate, and it has to be trusted, and it has to be branded, and the like. So it starts with client data. So today, just to give you two examples, today, clients with over $50 trillion of assets use our MSCI Analytics platform to run the risk and performance, right? So that is data that is sitting in our servers. That's data that we can access. There are not going to be too many firms that are going to be able to do that, to have that, because these people are not going to put their portfolios everywhere. They have to put them in a trusted place that they believe it's secure, that they can do their computations, safely and all that. That's one example. Another example is our clients have given us $15 trillion of their portfolio in private assets. That's sitting in our servers. We have access to that to put models on top of that. Now, we cannot disclose client A has the following portfolio, but we can use it to create products, and we can use it, to anonymize it and all of that, just like we can use the other one. The clients have 50 trillion in assets. So that is proprietary data. Now, that's in the back end. In the middle is the investment and risk models that we need to put on top of that data and then deliver that content. Yes, you could use ChatGPT to go look at something, and maybe the answer is right, maybe the answer is not as right. At the end of the day, we're not in the gathering information in order to have a political opinion, for example. We are, our clients are in the business of getting accurate data, accurate models, accurate performance, and all of that. They're not simply going to trust anybody. They're not simply going to get, a large language model sitting on the side and go do that. They need a thorough, trusted, reliable, branded product that puts its name and reputation behind it. That will be huge barriers to entry to a lot of people. So those are examples that I will give you, right?
Okay.
Thank you.
Okay.
And the next question will...
Hi, thank you. Just wanted to go back to the performance of, net new sales in the quarter. I know obviously there can be a lot of lumpiness, and you highlighted strength in Americas and Index. Just curious what you're seeing in EMEA in particular, because it sounded like net new sales declined. So just curious if maybe some of the new product innovation that you highlighted is more catered to Americas, or if there's something specific, maybe it's ESG related. So just some additional color there would be helpful.
Sure. Yeah, so I would say similar to the comments I gave overall, we see relatively consistent dynamics. I've mentioned in the past that we've seen a bit of sluggishness with asset managers in EMEA. We continue to see a bit of that. I think they've been a little bit slower moving on the rebound of the markets here. And so results have been a little bit softer in the EMEA region. our product development efforts are global in nature, and so a lot of the enhancements that we're making for not only asset managers, but all client segments are targeting tremendous opportunities within the European region. We actually, on the index side, see a growing ecosystem around our indexes within the ETF community. And so we've seen tremendous growth in assets under management and ETFs linked to our indexes in Europe, particularly around the world index, where we are becoming a standout in terms of largest ETFs, and that's perpetuating through to a whole host of additional opportunities. And so, yeah, we see some sluggishness from clients, some pressure, outsized pressure relative to the Americas, but our position there is very strong, and a lot of the innovations that we have across product lines are positioning us to continue to drive growth. And as I alluded to, that's not only on the index side, but in areas like PCS, many of the innovations you heard Henry talk about and Bear talk about in the prepared remarks are positioning us well to unlock big pools of capital focused on the private asset market in Europe. And we continue to enhance our go-to-market effort across many of these additional client segments in Europe. So continue to believe it's an attractive opportunity, but we are seeing in the near term a continuation of some of the sluggishness that I've mentioned in the past.
Thank you. And our next question.
Hey, good morning. How are you thinking about the expected timeline to utilize the $3 billion repurchase authorization? And to what extent would you plan to fund that with free cash flow versus incremental debt?
Thanks, Patrick. First of all, we love MSCI, and we love it even more when it's undervalued franchise. Clearly, we hit some soft spots the last couple of years, and the undervaluation of the company has increased, and therefore we've been pretty active in buying the stock. $1.5 billion year to date, and we got the board obviously to authorize another $3 billion to do that. We would like to be as aggressive as we can if the company continues to have undervaluation in the franchise and take advantage of that. And we are a strong believer in the medium, in the short, but more importantly, medium to long-term prospects of the company. I, for one, have done the same, not just with the assets of the company, but personally, in the last 18 months, I bought $20 million over the MSCI shares for me and my family.
Again, some things are very bullish. If the CEO is buying in the open market once per year, once in 2024 after the stock crashes, and now once in 2025 after the stock crashes, after the stock crashed, it's very bullish. It's very bullish.
It's not because of pride or authorship. These are rational decisions that given our opportunities, given the new product development machine this company can create, we will remember this period as a period of undervaluation that is a good opportunity to load up. So
again, the management is clearly telling people we are cheap. We think we are undervalued.
We're going to do the same with the assets of the company. Now, I think that in terms of the split, yes, in order to do the $3 billion over some reasonable period, we'll have to do both free cash flows and continue to lever up to 3.5 times or close to 3.5 times.
Okay, so they told you. This is what we were talking about for the buyback program and the debt level. You have an EBITDA target between 3 and 3.5. The CEO clearly tells you we will go to 3.5. This will continue to lever up to 3.5 times or close to 3.5 times. They are telling, I'm expecting things in a couple of months. You will take more debt. They could have said we will play safe. We are on the low end of our target. And we are now at 3. We want to see first what is happening, but we plan to stay on the low end. No, they're clearly telling you we will go to the high end of the range, 3.5. This ratio 3.5. So they will take more debt.
Provide us hopefully over $1 billion a year or something like that, and then we'll be opportunistic like we have always been.
Okay.
If the stock runs up way too much, we'll sit it out. Not because we don't believe it's attractive, but it's because tactically we can buy it cheaper.
Yes.
So that's our plan.
And just to be clear, no change to our approach to capital allocation, no change to our leverage targets. What Henry described is more of the approach that we've consistently taken, and so it's a continuation of what we've been doing.
Successfully. Next question.
Thank you.
Thanks. Good morning. Can you talk about how much pricing contributed to net new bookings growth?
Oh,
this
good
quarter,
question.
and what your strategy overall is around pricing?
Yeah, so I would say across the company, the contribution of price increases to new recurring sales is roughly in line with what we've seen in recent quarters. So no major shift in the approach. It does vary a bit across product lines and client segments. In terms of that approach that we've taken, we're generally trying to align price increases with the value that we are delivering. So many of the enhancements and improvements that we make and innovations that we've talked about here, we will be monetizing through price increase. And so that's a key component to enable us to continue to drive price increase. But we also factor in the overall pricing environment. We do look at client health. Our approach can vary product segment to product segment, even client segment to client segment. But importantly, we are really focused on being a strong long-term partner to our clients. And we are focused on building that relationship. And so we want to be constructive around price increases and very mindful that we need to continue to deliver value to be able to support price increases over time. But across the organization, no major change on the contribution.
Okay, and overall, price increases contributed to 30% of the revenue growth. So they are telling us it continues like this. This is something I wanted to have more information on. No major change in strategy. Okay. Next question.
Hey, good morning or good afternoon now, and thanks for taking my question. You talked a bunch on the call about some of the improvements that you've been making to your offering. I'm curious if you can talk about just the timeline for when we should see that show up. I know it takes time to hit revenue, but maybe in terms of the net new sales, to what extent have you been benefiting from those introductions? And it sounds like there's more coming through. So over what time frame, even high level, should we think about those improvements coming through? And maybe let's flip in a second one. Just on the AI benefits that you talked about and the efficiencies that you can gain. I'm also trying to think about the timeline there in terms of when we might see that start to show up in improved margins from here. So if you talk about the time, that'd be very helpful. Thank you.
Okay. Yeah, I would say overall, as you know, our financial model moves very smoothly. I touched a little bit on this in my prepared remarks, but there is strong momentum in releasing new products, and that is starting to impact sales. We've seen roughly 25 million of sales year to date from recently released new products. I mentioned the 16 million on the index side in my prepared remarks. And so we are starting to see these benefits, and that pace of acceleration in product development is definitely additive and something that helps us across many parts of the company here and allows us to continue to drive growth across not only the asset management client segment, but all of our client segments. And so it's one that we do believe is going to be an important driver of growth moving forward here.
He's not answering the question. It's saying, yes, it's additive, but the question was about the timeline. Like, do you expect the revenue to increase and to reaccelerate from 9% to more than this next year or in 2 years? This was the question.
But it's something that you started to see, but hopefully continues to be a big contributor to our success in the future.
Is he saying that it is the beginning, so it can only improve from here, so revenue will go up by more than 10% in the future? Is this what he's saying here?
Just on the impact on the financial model of AI, Henry touched on this, but I would say overall AI is enhancing to our financial profile. As you know, our business has tremendous operating leverage with high incremental margins. We are selling IP-based solutions that we produce once and sell to many users for many use cases, and that enables us to both invest in growth and drive attractive profitability growth on an ongoing basis. And so, as Henry alluded to, AI enhances both of those dynamics even more. So we're creating even more scale, enhanced productivity, enabling us to invest even more in the business, enhance our solutions, and drive attractive top-line growth as well as profitability growth.
Still not answered to the question. Maybe they have no clue when it will be incremental to the revenue growth. Maybe they don't want to share it with the public. Maybe they have no clue.
And as Henry alluded to, we are not going to take the margin down with some massive elevated AI spend. But it's something that will be a key ingredient to continuing to fuel that dual mandate that we have with our shareholders, which is continue to invest in the business to drive long-term growth and continue to drive attractive period-to-period profitability and free cash flow growth. And so it's something that will be a smooth impact on the overall financial model here.
Sugarcoating. Yeah, literally he did not answer the question.
And let me just add that the virtuous circle that we're trying to achieve over time is one in which we push higher and higher the operating leverage of the company to free up resources. Push higher and higher the operating leverage of the company, maintain the profit margins, and therefore free up significant resources to invest, back into the business. We have enormous opportunities in private assets, in index investing, in physical risk and climate, in wealth management, in GPs, in the faster money segment, hedge funds, broker dealers, data sets, investing and creating new data sets and all of that. We do not want to make those investments by taking the profit margins down. But we need investment dollars, and the bigger the investment dollars, the more we can achieve higher growth in the company. So that's going to come from AI. That's what we're looking for.
Thank you.
Next question.
Yeah, hello, James. Thanks for squeezing me in. Just wanted to circle back to the discussion on active ETFs. I think, Dave, you said you've seen an impressive 10% quarter-on-quarter growth there. I think it would be helpful to unpack your response to Kelsey's question and maybe give a bit more detail on exactly why growth in active ETFs does not cannibalize your revenue growth with active asset managers. And also, I wonder if you could confirm the other part of the question, which was the difference between the economics between the active asset management benchmarks and the active ETF benchmarks. That'd be helpful. Thank you.
Sure. So I'm not being cute, but it's genuinely unintuitive to me why it would cannibalize, right? So you think there's an active fund, it's benchmarked, and it's previously likely wrapped in a mutual fund or perhaps some other type in some other way. So then that same active fund, let's say holding everything else constant, it doesn't change its investment strategy, it stays the same, goes into an ETF wrapper, it's fundamentally pretty much neutral for us, right? But in fact, generally what occurs is the following things. One, in transferring into an ETF wrapper, it typically has a more rules-based approach, wants to be more transparent. It doesn't just want to move the fund into it. There are many occasions, I'm not saying it doesn't happen. There are a lot of funds that go straight into the ETF wrapper. But in many instances, the investment strategy is somewhat adjusted, or you could say quantification of the strategy. And we have a role to play there with our tools, factor models, etc. Then in turn, it may go a further step, and it may be, turned into an index. Maybe that those rules become more strict, and hence the strategy becomes an index. And in turn, many such strategies are being built from scratch today, and so we play the part in it. So I would say that, and in turn, the people who are doing this are generally, or not in the index or the passive, as people say. We don't like the term that much, but the index business. They're not the traditionally, there are some major, index players doing in the active space, but many of these are purely traditional active managers putting an ETF wrapper on a fund. So honestly, it's just not it's not a threat to the existing business, and there's a lot of upside for us in the future.
Yeah, and to add to the financial model is, in addition to the subscription fees, when that product is systematized, we charge assets under management fees on top of the data fees. So that's where the incremental revenue comes in.
Next question.
I wondered if you could share more on MSCI's product offering, revenue and strategy with the GP client base, given alternatives now make up over half the revenue pool with asset management. I also wanted to ask this in the context of the 5.5% run rate growth in the private asset segment and the opportunity in Thailand to get this growth rate up. Thank you.
So private assets, as you know, we have it classified at MSCI between real assets, real estate and infrastructure, and what we call private capital solutions, which has some real estate component on it, but it's a lot of it is private equity and private debt. So within private capital solutions, which is the former Burgiss company that we acquired 3 years ago.
Yes.
A lot of the business there has been built in creating tools and transparency for the institutional LP market. So the model is that an institutional LP gets presented with a proposal by a GP to invest. They invest, and they invest in hundreds of these things. And then they turn to us and say, can you help me understand all of this? So we go to the GP and tell them that we represented the LP. The GP gives us all their data, every single data that they give the LP. And therefore, we aggregate that data. And then we look at the funds. We tell the institutional investor what's in the fund, what is the benchmark, how are they doing relative to the benchmark, how is the performance, how is the risk, when will the capital be called, when will the capital be returned, and all of that. So in that model, we get paid by the LP, and that's largely the business model today. So what we're doing is two things. Is we're creating the product line that is similar to the institutional LP, so it can be used by the wealth LP. which is not a big transformation. It's just reprogramming the tools of transparency, of understanding, the benchmark, the performance, the risk, and all of that in the portfolio, the creditworthiness, the market risk, and all of that I talked about in private credit, and then serve it up to the wealth management organization so they have the same level of transparency and understanding what they invested in as still limited partners, because they are, instead of being an institutional limited partner, is now an individual limited partner or a pool of limited partners. So that's one part of the growth. The second part of the growth is to then, which we're doing right now, is to create products for the GPs, because we are in the ecosystem. We're talking to GPs every day because of the role that we play for with their investors. So we go into the GPs and we launch a few products recently. We launched one is called Asset and Deal information in private equity as to looking at every deal, at every asset, and based on our database, and provide that as a reference for the GPs to see who's doing what around the industry. So right now, our revenues coming from GPs directly on private assets in private capital solutions is minimal. A lot of the revenues that are coming from the GPs right now are in analytics. We help them, risk manage their assets. We help them with indices in certain parts of the business. We help them with sustainability and climate. But our revenues coming from from private assets of these GPs is minimal. I don't know, $5-10 million, some number like that. That is a massive opportunity for us. So those are the three strategies: are deepen our penetrations on the institutional LP, expand to the wealth or individual LPs through the wealth management sector, and build products for the GP, which we have all the underlying information and the data and everything. It's just a question of building products.
Okay.
This does conclude today's question and answer session. I would now like to turn the call back over to Henry for closing remarks.
At the end of every earnings call, the CEO of MSCI is doing a comment, concluding remarks, and every quarter he's changing the concluding remarks depending how the stock operates and how the business performance is. So let's see what he has to say now.
So thank you very much for attending. Obviously different tone from last quarter. I normally say to people, it's darkest before it's dawn, and we feel that the dawn has arrived and we're turning the corner here. It's not going to be a straight line. It's going to be lumpy. We're not in the kind of business that flares up and flares down. It's a consistent build-up, and it could be a little lumpy, but we're very optimistic about our prospects now. So thank you everyone for joining. As you can see, we have an all-weather franchise delivering significant performance and attractive margins. We're a mission-critical tool. Our footprint has largely been product-driven, and now we are expanding more strategically in a lot of different client segments to link the ecosystem and benefit from that. So and that will bear value creation over time. We're a long-term compounder. We're not a flare-up, flare-down company. So our goal is to continue to build higher growth, higher profitability on a year-in, year-out basis, year-out basis to be a long-term compounder of EPS and growth. Thank you very much, everyone.
This concludes.
Wonderful. How can you not be bullish when the CEO is talking to you like this? The CEO loves the shareholders. The CEO loves the shareholders. He wants the earnings per share to grow in the future. He knows that in the very long term, the stock price will follow the earnings per share. So he wants the earnings per share to grow in the future. The CEO is buying the stock. The business is improving the margins over time. And the business is clearly telling you margins will continue to trend up in the future. We will implement AI for all our operations. We don't need to hire more people. It will just be an incremental boost to the future. So margins are expected to go up. Revenue is expected to go up. The client base is expected to go up. The ecosystem is here, and the costs will not grow that much. So the margins will improve meaningfully. They will continue the buybacks, and the earnings per share are expected to go up. If you think that the free cash flow in the future can grow at 15% per year, and if they are doing 2% buybacks, and you think this is a stock that deserves a price to free cash flow of 30, if you buy right now, you can expect a CAGR of 15% per year. This is quite good. And as the tone of the management is shifting, they are getting more bullish. What if they grow more than this? You are talking about a CAGR performance, a compound annual growth rate, if you buy right now, between 15% and 20%. So, and that's only with the price to free cash flow of 30. In the past, it had a P ratio of 35. So it's totally feasible that MSCI generates 20% per year if you buy right now. That's it for this earnings report. I hope you liked this new format. This was a very long video and I hope you got a lot of value. This was the only video you needed to understand this earnings report. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.